Good morning, all of you. May I request Chairman Sir Rinkesh Shah and the Sanskar CS Sanskar Shah to take the faculty on the dais. I request all of you stand for the ICAI motto.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनाद्यति कश्चन एतद्वैता 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 एतद्वैता.
It was pleasure to introduce on behalf of ICAI Ahmedabad, CA Vijay Gupta. Vijay Gupta is the family member of the Chartered Accountant, Company Secretary as well as Cost Account of India. He is pursued BCom Honours in the Sri Ram College of Delhi University. He has over 4 decades of the post-qualification professional experience. He renders advisory service under FEMA, including foreign investment, both inbound and outbound, non-residents, NRI, OCI, corporate law, secretarial practice, private family trust, succession planning, M&A, and corporate business structuring, transaction advisory, international tax, income tax, and valuation advisory. He has participated as a panel expert and speaker and presented background material and presentation papers on FEMA and M&A at various seminar, workshop, and study circle meeting organized under the ICAI, NRI-ICAI, ICAI, CTC, BCS, and other various professional forums. He has served as the chairman of the Delhi chapter of the Chamber of Tax Consultants during the year 2019 to 2021. I request Chairman CA Rinkesh Shah sir and the CA Sanskar Jain to present memo to the faculty. Actually, I have received queries across all participants regarding the PPT presentation. So the PPT present is already uploaded for all the 4 days on the WIRC Ahmedabad website. So please, we request you all participants to download PPT presentation from the website itself. Thank you. Now I request here Rinkesh Shah sir to please give his opening remarks.
Good morning, respected participants. Today we are on the 5th day of the intensive 11 days series of FEMA. Today we have with us CA Vijay Gupta sir. He all the way came from the Delhi. As Jai sir has given the introduction of Vijay Gupta sir, I would like to add that since last more than 15 years, he is into this field and addressing at the various forums for the FEMA and international taxation. Friends, we are fortunate that today he is going to take the sessions continuously up to 1:30. He will give the tea break. I request all of you, the tea arrangement will be done at the second floor itself. Tea and cookies will be there. When the break will be given around 10:30 or something like that. And post the session, you will go to the lunch. And we are fortunate that sir flight is today evening. So I request all of you, if you are comfortable and the post lunch, if you want to have any discussion with the sir, any kind of questions, because today he is going to cover the specific topic given to him regarding the FDI, regulations and reporting framework and FCRA and other stuff. But regarding FEMA and international taxation, any kind of questions you want to ask or have to have an interaction with him one-to-one, post lunch he will be there in the conference room on the third floor, exactly opposite the chairman cabin. So I request, take the maximum advantage. If you have any question, you can come to meet him directly. Once again, I am requesting, yesterday also I have requested the Europe seminar, India-Europe Treaty has been done, and the deals, various deals have been done with India and Europe. For that, we are fortunate that faculty from the Dubai is traveling to India and coming to the Ahmedabad branch. And we are having the High Commissioner of Cyprus, who is representing as a President of European Union. He is coming and addressing to all of us. So I request that there is a program on 27th on Monday regarding India-Europe treaty, and it is followed by dinner. So I request again to register for the same, because the registration is going to fill fast. So I request to fill as early as possible to avoid the disappointment. Thank you. Thanks a lot. Once again, I congratulate all of you for having the attending at this FEMA series. And step by step, as I already told, once the FEMA series is over, we are going to have the series like international taxation and other taxation, other matters. So definitely, I will love to host you again and again. Thank you. Thanks a lot. Over to you, Jai sir.
I request CA Gupta ji for to take his session. The floor is yours, sir.
Yes. Good morning to each one of you. So can you hear me or not? Can you hear me? And there, can you all hear me now? Yes, good. So again, good morning to all of you. So thank you to Chairman Bhai and Jai Kumar, Mr. Jai Joshi, who found me to come to Ahmedabad for our institute branch, and I am indebted to institute. I qualified in 1981. So whatever I am today and whatever I give you deliberations, it's all because of my degree of chartered accountancy. So whatever I have learned and practiced in last 30 odd years in FEMA, FDI especially, I was quite an expert on FIPB before it got dismantled 12 years ago. So FDI I have been handling for the last 30 years. And other than FDI, I have been now gaining knowledge as a student for last, I think 20 years now on other than FDI, be it ODI, ECB, LRS, NRIs, OCIs, immutable properties, the whole gamut of FEMA. And even at this stage and age of my life, I still find that there are many professionals who are better equipped than me, and I am still a student of FEMA. That is why I attend all seminars, all conferences on FEMA, wherever these are happening. And after COVID now, most of these are virtual now, so I have an advantage, like you people also have advantage of attending those. I don't miss any. Of course, I may not attend all the lectures which are series, 10 series to 15 series, but surely I get the PPTs, and then you have to glance through PPTs and then understand what is there. So what I'm trying to emphasize to most of you here, because I understand from Jai that 50% of the participants are new to FEMA. Another 25% have good experience, and other 25 or 10% may be having good knowledge and good practice on FEMA, maybe better than I know. Few of them may be knowing better than what I know. So my attempt in this next 4 hours or so, and maybe a little less than or more than, depending upon how much you feel interested in my deliberations, is to give you not only what is the law on FDI. I will restrict myself to FDI. I will not try to go to other rules and regulations unless it is really necessary. Of course, there is an add-on which I have to cover on FCRA. So I will cover that, limited to FEMA interaction or linkage wherever it is there, not whole of FCRA. And I have always been thinking how to make my PPTs and how to give lecture or deliberation, because I am not an expert in giving lectures like this. I am more of a person who absorbs rather than, giving, more of introvert than outward, or outward, as we call it. But at the same time, I have seen many kinds of PPTs which are available, and people have their own comforts. But my comfort is always like this. I just show you one random PPT, right? Like this. Like this. I will reproduce what is there in the law, whether it is regulation, whether it is a rule, whether it is FAQ, whether it is a case law, whether it is some other, part here and there, wherever. So my PPTs are that way very authentic in terms of contents. And I have a habit of then highlighting in bold, either red or in black, or red only, certain words or sentences where the emphasis lies from practical point of view. Because in every legislation or the written law, whether you have, because most of us are tuned more for income tax and GST rather than FEMA. And the Companies Act also, not many people are very comfortable. Since I'm also company secretary since 1980, so I have a good exposure to Companies Act and SEBI also. So what I have learned in so many years is the FEMA is very, very different from what we have all been studying and practicing, whatever experience you people have individually. That on those legislation, whether it's income tax or whether it is Companies Act or it is GST, you have a lot of material available, not only the basic law, the act, rule and form, you have lot many judicial precedent, lot many articles, lot many seminars, because in our CA Institute, if I put it just overall, I think 95% of time is spent on income tax and GST. And international tax, they have started, but there also, I don't think there is much of a deliberations happening on international tax. And my experience dealing with the corporates, because most of my clients are corporates, individuals of course yes, but most of them are corporates, is that today, maybe in the last 15, 20 years now, more so in last 10 years, you cannot do any international transaction or structuring, or as you call it M&A, or even a small normal transaction of export and import, or for NRIs, residents becoming NRIs becoming residents, returning Indians, and students going abroad, LRS, anything, everything. Unless you have basics of FEMA, it is difficult for you to finally make out a structuring which will go through ultimately. Because I have seen many a times that people will make some structuring within their knowledge, good knowledge, expert knowledge of income tax, of Companies Act, but it will fail at FEMA ultimately. Many a times I have seen this. So when I attend these kind of seminars, so it is for me unusual that I am on the dais speaking like this, but generally I am on the other side. For last 15 years, I have been regularly attending these 4-day, 3 days RRCs of institutes and not institute, but I'm not promoting here any specific institution. I'm just adding to your knowledge as a co-professional that from wherever you get knowledge, you come, isn't it? So I have been attending, even if I had no knowledge, I have been still attending, listening to the people who are, top class. You can't find a person better than those individuals speaking on the dais. And when you try to learn from them, one is that you get depressed. One is that you make impression that I don't know. The fellow has spoken for 2 hours and I don't even know what he is talking about. It is all going above my head. I can't even relate. But over a period of time, I think I was talking, Jay was telling me that, and with this current branch and current dispensation at the institute, they are trying to promote, people here, professionals here, to learn more about international and cross-border transactions and structuring, in which FEMA is, of course, very, very important. And with this gift city in Ahmedabad for so many years, but I think last 5-6 years, it has really got momentum. And then with this new train, bullet train, and coming to Ahmedabad, and the government at the helm of affairs today is promoting Gujarat and Ahmedabad, I think it's the right time that you all people get into all these things. Give me 2 minutes more to talk to generally, then I will come in my flow. And it is always better, unlike, is my television recorded or not recorded? These are recorded? Okay. So I have to be careful then. So, coming back to the PPTs, I have not been able to convince myself, in spite of seeing very fantastic PPTs prepared by people, and especially with this new AI, ChatGPT, and a lot of other Gemini, and a lot of sites, which give you automatic, some designer outfits, like as we call it. So I have not been able to convince myself that that is the right way of doing it. Maybe sometime, but if you have to give knowledge to the co-professionals of whatever I have learned and earned in the last so many years, so my attempt is only to share whatever I know. And whatever I know, I will share. If I don't know, I will say I don't know. But take it from me, if I say I know, it means I know for sure. It means don't discount it. Maybe 5%, 10% you can discount, because everybody can have 2 views on a similar matter. Even high courts differ, Supreme Court differ. You have 9 bench, you have 13 bench, or 2 bench, etc., etc. But if I speak with a lot of conviction and a lot of practical knowledge, not only theory only. Theory, of course, without theory you can't proceed. And when I run through my PPT, there are many. And my attempt will be to see that I give justice in whatever 4 hours I get here on this topic. And look at my PPTs. Don't note down anything there from the PPT as such, because I will be talking generally, seeing on what I have to emphasize. And when I am concentrating on that particular sentence or a PPT, you may find that I will give more of practical orientation rather than reading out the PPTs only. I will read out some part of it, of the PPT, which is important, but I think more is, if you are attentive in listening to what I'm saying, not attentive there, I think you will be able to absorb more. The purpose is, for my purpose only coming here is to give. When I'm sitting there, I always take. I only absorb. But here my purpose is to give to all of you, so that those who have or are new to FEMA, they don't only get interested in FEMA as a subject matter. It is not a dull subject. It is a very interesting subject, but very difficult to understand, very difficult to practice, because you may read the law, which looks very simple, But you will find there are n numbers of complications, practical things which come around it, and you are not able to find an answer. Many times, not once. NRI becoming resident becoming NRI, then you have properties here, you have immobile property here, then you have bank accounts here, you have foreign account, you have son, a lot of things happen, including FDI also. You see, you don't, when you go for FDI, then not only that you must know the law. As practitioners, what I'm supposed to do is also to know what is the practice and what are the compliances around that particular transaction. And if we omit on that, or if we forget about that, what is the way out? FEMA, there is no way out. If you are contravened, you are contravened. As simple as that. Go to AD Bank. AD Bank may give you some answer. You say, you give me some document because person who is coming to you is a relationship manager. He has a back office. Back office is in that state, like in Gujarat. But the FEMA team is sitting in Mumbai. So you won't access to that person. So in the meantime, you'll find at three places your query is going, document going, and then ultimately when it reaches the concerned person, he gives you a different answer than what you are expecting. Then go to RBI. RBI doesn't listen to you. Now today, RBI has no interface with any professional or a consultant. Even compounding also, if a professional goes with the client, they ask the client representative to speak, not the chartered accountant or advocate or anybody else. They say, you please let's listen to this person, and then ultimately they give an answer. And you have no way wherein you can go to RBI and meet people and give queries. So that has stopped now. Earlier it was there 6 years ago in Delhi, also Bombay, also it more or less has stopped now. So when I come to a particular slide and a particular subject matter, because FEMA FDI is very elaborate, very, very elaborate. And so concentrate on the PPT also maybe, but also concentrate on what I'm saying. What I'm saying will give you an idea that in this whole sentence, what is important here. What word is important, what sentence is important for the purpose of not only understanding of law, but even to put it into practice, even for a compliance matter, right? So what I have done, one is that I have made index so that you people know that what I will be covering. So one is how to find material to read, where to read, how to read, and how to connect these each other. I will take some time on the 3-4 slides because these are very important from practical point of view. Then key definitions. Then we have, can you see my cursor also moving around? Cursor moves here? No, cursor will move. Okay. Acha, okay. Where it has gone, yaar? Where it has gone? Not working, huh? Acha, iske impact nahi aata. Acha, LCD, okay. So then you have eligible investors. Then you have this new press note of 2026 on that land border sharing investors, which is basically China. Then sectors and activities. I have given a lot of emphasis on sectors and activities where there are some restrictions or there are some ceilings and upper ceiling and some conditionalities. Then you have startup and convertible notes. Then valuation and pricing, that is what is our domain as a chartered accountant. So I will give you a lot of insights into the valuation and pricing, how people do, and what is the way out, how do you find an answer to a particular situation. So I have given a practical touch there. Then you have ESOPs, then transfer of instruments, swap, investment in listed Indian company, because people are always struggling to find an answer that can a foreign person, company, individual or whatever, can that person invest directly or indirectly in a listed company in India, directly from abroad or through a company in which that person, company or individual has a FDI, right, or any other investment. Can that company invest without any approval, or it is permissible or it is prohibited? So it is quite interesting slide. And then M&A, merger and acquisition and demerger, how if that happened then, and there are foreign investor and shareholders, how that is addressed under FEMA. Then your rights issue and bonus issue, that is also quite a complicated issue. Looks very simple, but little complicated in terms of compliances and understanding. Then indirect foreign investment, which is called downstream investment. If a company has FDI and other modes of inbound investments, can that company invest downstream at layer 2? If the layer 1, layer 2, layer 3, that if at what percentage and control you have to comply with the law, and what is the law, and how it is done, and how it is different from the mathematical formula, proportionate formula, which we have learned as chartered accountants, which is entirely different under FEMA. Unless you know, you will never be able to visualize that what FEMA says. So people who have practical on this, I think you listen to these, listen to my deliberation on that, and especially my slides. I think it will be quite an eye-opening for you, and it has a lot of practical material, especially those who deal with this. If you don't deal with this, I think it will be then difficult to even absorb in the first lecture. Maybe second lecture you would start asking. Then hedging of FDI, then statutory auditor. Is anybody here aware that if there is an FDI in a company, then there is some condition attached to appointment of statutory auditor? Please raise hand if somebody knows about that particular clause. It is a two sentence only, 2-3 sentences in the whole policy. If I have an FDI in company in India, and as per the JV, joint venture agreement, there is a condition that the statutory auditor of this Indian venture will only be out of Big 4, or specifically by giving a name of that this particular firm will be there, or anybody else. Is there any restriction under FEMA or FDI policy on that? Has anybody read it ever? Please raise his hand. I don't ask questions. Nobody. So very interesting. I'll come to that. So then there are, other than FDI, because our emphasis is on FDI, more on FDI, others are also important. Schedule 2 is for investments by foreign portfolio investors, as we call it FIIs, on a repatriation basis. Then Schedule 3 is investments by NRIs and OCIs on a repatriation basis. And I am told that NRI and OCI definitions and other things you have understood in the previous lecture. Then Schedule 4 is investments by NRIs and OCIs on a non-repatriation basis. What is repatriation, what is non-repatriation, we'll discuss. Broadly, it means if it is repatriable, it means any income earned on that investment, which is broadly dividend, can be repatriated. And if there is a capital gain on transfer or exit or whatever, in whatever manner, that can be fully repatriable. There are no ceilings in terms of, but if I have invested $100, can I repatriate $1,000? Answer is yes. If I have invested $100 in a listed company, that becomes $2,000. Answer is yes. That is called repatriation without any restriction under FEMA. Of course, income tax will apply. It's a different law. And non-repatriation is something else that I will discuss with you. What is the difference between repatriation and non-repatriation, and especially in case of NRIs and OCIs. And then another issue of non-repatriation. This is a case where you must have heard in the previous lecture that a resident goes abroad and becomes NRI, right? Non-resident. What happens to his investments and deposits in India? And what happens to the income which is earned on that, including capital gains? And what are the repatriable rights available to him when he becomes a non-resident under FEMA? Right? So this is a slide which is a very important one. And this is an abstract from a master direction, which generally people skip. Next is Schedule 5, investments by other non-resident investors other than FPIs and NRI-OCIs, means any foreign investor. Then you have important one, which is LLP on a repatriation basis. LLP on non-repatriation basis covered by Schedule 4. But Schedule 6 is repatriation rights. Then you have FVCI, Foreign Venture Capital Investor, which is registered with SEBI. And then you have investment vehicles like InvIT and REITs and AIFs under SEBI regulations, AIF 1, 2, and 3. Then you have issue of Indian IDR, means a foreign company issuing shares in India, listing it in India. Like I remember only one case, which is Standard Chartered Bank long back, but there has been no other case. So certain things where I find because of time or because of interest, I have to skip. I will skip those little faster, because then you have these, of course, all these whatever I have abstracted here is from whatever is available on FEMA under RBI. What are those? I will list out them, so that if you read any of those 6, 7 documents, you will really reach that stage. Suppose, how do you search? You have my para, you have 4 words, then you open those 6, 7 documents, which I will refer separately with you, and put that in the search column. You will reach from where I have taken it, right? So my slide, as I said, my slides are very authentic. Maybe 2%, 1% maybe here and there, but otherwise they are very authentic. You will find it somewhere in some RBI documentation or some case law or somewhere you'll find somewhere. Then you have payment and reporting. Though I have covered payment and reporting in the respective schedules also, 2, 3, 4, 5, 6, but the FDI I have covered separately where there is a special reporting required or special payment instruction required. Then you have, I've covered it as separate item, debt instruments, which are not equity or not preference convertible. So this is a separate schedule in FEMA, because when you say FDI, you're talking about non-debt instrument rules. But when you talk about debt, then it's a debt instrument, debt regulation. The difference I will discuss broadly when I come. Then the last is FCRA, on which I will spend, I think, 10-15 minutes, not more. And if time permits, then maybe I will take something else, right? So this is just a bulletin of March 26 of RBI. Every month it comes out with the bulletin on FDI. So interesting part is that April 15 to January 26, there is a negative inflow. When it called negative inflow, it covers both FDI in inbound and also outbound. Both is net off, then they come out with a figure that how much is the net outflow. This I am reading out to you so that you feel interested and as to what is the gamut of things here. We are talking FDI, but we can't ignore ODI. ODI, I think, was taken yesterday. Yes. It has already been covered, or it will be covered tomorrow, later. ODI already covered. So if you listen to me, an FDI, and if you have attended that ODI and you have absorbed something from there, I think you will be able to relate what is the difference between ODI and FDI. It is very important because ODI and FDI are different ball games altogether. You cannot relate what is in FDI with also within ODI or vice versa. No, it is not there. There are specific regulations on a similar matter. There may be difference between ODI and FDI in terms of what the law says, what is the procedure. So then it was said around 70%, 5% of FDI is coming now from US, Singapore, UK, and UAE, not from Mauritius, not from Netherlands, which was the case few years ago, because after all these PPT and MLI and BEPS coming into force, all these fancy structures of TT shopping and no tax anywhere in the world, I think more or less they are on the way out, and especially with this Tiger Global judgment, I think whatever was left out has been killed there. But unfortunately, I'm saying unfortunately, some professionals and firms are still hyping on that. Still they feel that to make money we can sell this. So we have to be, as a professional, very careful, not only ourselves but with the client also. We have to tell the client that look, forget about all these TT shopping and all these things. Let us go direct. So that is why my purpose of giving to you is only this, not other statistics. Other statistics is incidental. Second, this was May 25. Why May 25? Because I gave lecture in May 25 in BCS, so I have that time I made, so I said let me reproduce that here also. What it says, net FDI inflows moderated during the period, higher repatriation outward investments, which is sign of, which say important word which you must learn, which is sign of a mature market when foreign investors can enter and exit smoothly. This is an important word. You relate it to what is happening over the last 3-4 years. You must have heard this term called reverse flipping, right? In various seminars and maybe articles here and there. What it says, earlier people used to go outside India, Singapore, US, European countries to get the shares listed, and income underlying investments is in India. It means the business is in India, but they want to list it abroad so that you can get a better scope, better investment, and better pricing. Now people are shifting back to India. So this is called reverse flipping. So this is the sentence which enforces that, which is a sign of a mature market where foreigner investors can enter and exit smoothly. Unlike other countries you have in the Asian, wherein you see once you enter you can't you can't exit, which was the case in India also before this FEMA and maybe 10 years back. But now I don't think if you follow the law and you are within the law and the valuation and pricing guidelines are fair and arm's length, I don't think anybody asks you any questions. Like I said earlier, if you invest $100 and you want to take out $1,000 after 5 years, nobody will question you. So long as your documentation are correct, your balance sheet is up to date, valuation report is fine. So nobody question unless they suspect some money laundering or hawala. And that is why people are wary of going to some countries wherein people are not very comfortable. I don't want to name the countries, but these countries are good, you see, like which are mentioned here. UAE, of course, with this problem now may not remain that lucrative. UK, Singapore, UK, and then Japan and other countries, they are really good. And then what it says, sign of a mature market where foreign investors enter and exit smoothly, which reflects positivity on the Indian economy. Gross inward FDI witnessed a double-digit growth and stood at 7. So about a year ago it was positive, now it has become negative. It means more money is going out of country. Nothing to worry as far as we are concerned, because I am not deliberating on the economics or the macroeconomy. I am deliberating on the FEMA. See the FEMA. It means you can enter, you can exit. RBI has accepted this is a way of life. You invest abroad, you want to bring it back into India, nobody asks questions, right? So long as you are, it's a commercial judgment, commercial decision, and you are fair and it's on arm's length, right? So now, important aspect from the practical point of view, that how and where to find reading material on FDI. I will restrict myself to FDI, though I know Shabir Motorwala ji on the first day has covered lot of things on overview, and he himself is an expert and better than what I am today. And he is also one of the person from whom I have learned passively, not one-to-one, but listening to him, seeing him, and all those things. So he is a class by himself. So my FDI part, where to find and how to find. One is foreign investment is regulated. The power is with the central government to make rules, not the RBI. RBI makes regulations. Both are in consultation with each other. Government will make rules with consultation RBI, and RBI will make rules, regulations, and master directions, etc., in consultation with Government of India. And non-debt instruments, which is our subject matter today, includes all investments in equity instruments, whether it is private, public, or listed or unlisted company. LLP is not, LLP is separate chapter, so I am talking about company only. The first is rules. And in short, in terminology, it is called NDI rules. Then there is simultaneously, RBI came up with a regulation called Mode of Payment and Reporting of Non-Debt Instrument Regulations. So this small regulation covers what are the permitted payment modes, both inward and outward, and what is the reporting pattern. How do you relate these two? These two are the basic and important at a first level documents. Then everything is linked to it. What are those linked documents? One is master directions on foreign investment, which is released by RBI regularly. As and when there is an amendment, they update it. But the old one remains same. They keep on updating it. So this is basically a simpler version of what the rules are and what the regulations are. At the same time, when RBI issues circulars to AD Bank for implementation, so those are also abstracted in this master direction. So what you have to read? You have to read rules, regulation, and master direction, 3 documents. Because master direction, like these sectoral caps activities, which runs into 8-10 pages, is not covered at all in the master direction. It may be true for another regulation, but not here. ECB is coming tomorrow sometime. ECB, what is it? I'm just giving one example. ECB has been substantially revised last month. Earlier, the borrowing and lending regulation was very small. Everything was in the master directions through the ADA circulars. Now they have put everything from master direction to the regulation itself. Master direction has become very small, 1 page or 2 pages only. Here, what I'm trying to tell you, don't skip reading, because something you don't find in master direction, you may find in rules, or vice versa. But generally, whatever in the rules, it is generally abstracted in the master direction. But here in this case, master directions, like I give an example that the whole of sectoral activities is not covered by master directions. Then there is a FAQ. Though this is an old FAQ, which was released before rules came in 2019, but those FAQs still has a good persuasive value, because the substituted NDI rules and the old ones more or less same, with some change here and there. So those FAQs which have similar law in the earlier regulation and these rules will apply to you, even and those FAQs will also apply. So it is important to read. But otherwise, if you see the new book, new thing, they will not talk about FAQs. So you have to be mindful of that. And next question comes from where to find. I will come to that, I think, next quarter. Then you have Government of India, Ministry of Industry and Commerce and Industry, which you call DPIIT, Department of Promotion Industrial Policy. They then release. Earlier issue used to be every year. Now they are not releasing. For last was in 2020, and then they issue press notes every year. Like in 2016, they have already issued 2 press notes. One is on insurance, and second is on this China investment. And 2025, I think it was 5 or 6 only. So these press notes is approved by the cabinet and put into public domain as part of ministry's power under the regulation of power of the government departments. But these are not effective unless they are put into FEMA by way of a notification, by way of an amendment into the rules. Like this China, this new dispensation of beneficial ownership has come earlier, but it has not still been notified under FEMA, so it is not still operative. It will become operative only when FEMA, it is introduced in FEMA. Because any conflict between press notes and FEMA notification will always prevail. Then you have master directions for reporting. It is a very big one. It covers not only FDI, it covers ODI, it covers ECB, it covers LRS, it covers branch office, license office, all those things. So my request to you is don't concentrate on this. You will get PPTs. I will share all the PPTs. So you take notes. I think that is important, and to listen to me, because you will get more. You will absorb more when I am talking to you. Then master direction reporting is very important. You will not find what is mentioned here in the reporting regulation, because they are very specific. And then you have, in May 25, there was a RBI framework of circular. We say that when I say regulation will cover everything, anything. It is not that only regulation. Regulation will cover regulation, direction, guideline, notification, orders, policy, everything, anything what I say is a law. Not that what I say is not a law. It means you have to read not only the Rules Regulation Act, you have to read anything, everything in public domain by RBI. Also, that is a law. Because RBI will say, I will follow what is there available to me by RBI, not what you show me otherwise. Then this is another portal, RBI Foreign Investment Reporting and Management System, which is a forms. It is called in every forms. Then it is .rbi.org. So what it has 4 documents available there, which are updated regularly. Say once in a year is minimum, maybe more than once in a year also. So what it has? The one is a business user. Second is entity user. Third is FAQs. And then there are contact dates of AD and RBI offices. So these are important for you to understand and read for the purpose of compliances. Because anything, everything under FDI is through RBI portal. You don't file any hard copy with the AD bank. It is all through the portal of RBI, which is forms portal. It goes to the designated branch of AD bank first, and then they take it to the RBI if required. Otherwise, they approve it. So these are, I'll show you what it is. Maybe in the end, sometime if you get time. So that once you have seen from your own eyes, I think it will be easier for you to recall. For someone who has not read it earlier, it is for those participants, not for those who are already aware of it. Then you see for government approval, because most of the time when we deal at professional at our level, generally we are not supposed to go to government for approval because of sectoral caps and China, etc. And whenever that thing happens, people generally go to big law firm or big four because they feel that they have better mandate to handle it if the government rather than other people, because it is difficult and it is very, very time consuming. So for that, DPIIT has come up with the standard operating procedure, which is amended once in a year or so. All proposals which require government approvals. So and then they have a site in the last RBI platform for regulatory application, which is called Pravah, which is a new which came last year. So you have to through this portal you have to file your applications with the government for approvals. RBI is through forms portal and government is through this portal. And then sometimes people struggle as to what are the codes for a particular industry or for the particular business activity, because these activities are specific. Wherever activities are allowed under automatic route, and some activities are allowed under government approval. Some activities have some threshold that up to this level you can do automatic balance, you have to go to approval. So generally people struggle in terms of to find a right NIC code for your activity. And there are cases wherein a company may be engaged in more than one activity, right? It is not necessarily that do only one activity, it may be multiple activities. And we are generally aware of, under GST, we know, you see, how to place your activity, because GST, we all handle service or goods basically, and HSN code as we call it, right? And then when we file on MCA, our documents, this MGT 7 and AOC 4, there also we have to mention the activity code. So those are different classification, different codes. Then we pick up from there and then we do it. And then for the purpose of FEMA, they rely on NIC code 2008. And in that, it is 3, 4, 5 digits, etc. So there you do it. And then DPIIT in 2015 had mapped those NIC codes with the policy that these NIC codes are under automatic route, and these NIC codes need government approval, or these NIC codes need government approval under threshold. It means wherever you get stuck, you find an answer through the DPIIT mapping as to whether I am falling under government approval route or a different route, or I am automatic route. So this is also very, very important in terms of then how do you report? When you report, you have to report only one NIC code. You can't give more than one NIC code. And one NIC code which is my prominent intended objective or prominent activity what I am doing today, because form doesn't accept more than one NIC code. Of course, you can inform AD bank in terms of other documentation, but otherwise, then the next question generally comes, if I have changed the NIC code, I have changed my activity, but change the activity, then how do I do it? There is no procedure under FEMA or a form wherein only NIC code can be revised or amended. There is no such procedure or methodology under the forms portal or RBI. So generally what people do, then they will write to AD bank, because AD bank is the intermediary between the RBI and the company, which is AD bank. So you inform them in writing and that him keep it on record, and you take an acknowledgement tomorrow if somebody asks you a question that what is your activity. Then the schedules, as I discussed earlier, then there are so many schedules. So now we come to definitions. How much time I have spent already? 40 minutes? How much? Okay. So I was talking generally now. So is my speed, you need me to increase my speed, which I intend to, or not? Yes? Okay. And whatever I'm saying in terms of my accent and in terms of my English language, are you able to understand, all of you? Or if you feel I speak something in Hindi also, I can do. Of course, Gujarati I can understand, but I can't speak, so I'm sorry for that. But Hindi I can speak well. If you want me to also cover some Hindi, I can also do part of it Hindi also. हाँ जी? हाँ, इंग्लिश क्या होता है, मेरा फ्लो इंग्लिश में यू रीड एंड स्टडी तो यूज बेटर, बट कहीं अगर फंसेगा तो थोड़ा हिंदी में डाल दूंगा, लाइक नो आई एम डूइंग. ठीक है, गुड. हाँ जी, ठीक है. हाँ जी, हिंदी भी चलेगा ना, लेकिन हिंदी में फिर आपको सेंटेंस नहीं मिलेंगे, ये जो है ना पेकुलर सेंटेंस का हिंदी नहीं आएगा मेरे पास. हाँ, चलो मैं देखता हूँ कैसे मेरा फ्लो बनता है. ठीक है ना. अब देखो इसमें FDI के अंदर there are few terms which are important to understand and learn, because in any legislation, any act or any rule, you find that that particular act or a rule has a specific definition specific to that particular act only, and generally it is given, and then anything not mentioned here, you either go to Companies Act, you go to FEMA, you go to some other act like that. It's like in FCRA, you say anything not defined in FCRA, you go to FEMA, or go to Companies Act, or go to some other act. So you have, I will take you to the specific nuances of that particular definition for you to understand what it means. If you read in a flow, you may skip that, but if you consider, I think you will be able to understand. The first is, what is FDI? FDI is an investment through equity instruments. It says equity instruments. It doesn't say equity capital. By a PROI, it is a abbreviation term. I use it most of it. It's a person resident outside India. PORI, person resident outside India, and if say II means Indian. PROI means outsider. PII means Indian. In an unlisted company or more than 10% of a listed company. If anybody from outside has more than 10% in a listed company, then it automatically becomes FDI. And who can invest in listed company, that I will come later, right? Which is predominantly FPIs or NRIs, OCIs through stock exchanges. Nobody else is allowed. Then it's a fully diluted basis. Fully diluted basis means even taking into consideration futuristic equity instrument converted into equity capital. Like you see in our accounting term, we have EPS. We have EPS for the share capital outstanding at the end of the financial year, including weighted average. Then you have instruments which are not converted, but which may get converted later. So then you have a EPS. There is accounting standard on that, wherein you calculate the future shares which may be allotted. Then you calculate the EPS on that basis, diluted and otherwise. So what is fully diluted? It says total number of shares, not paid up capital, not differential voting rights, nothing. Ignore anything, everything else. Total number of shares. That would be outstanding if all possible sources or conversions are exercised. Which are those? Equities, standalone equity. Equity, if you have differential voting rights equity, you ignore that, you only go by nominal capital. Then you have fully and mandatorily convertible preference shares. Fully and mandatory convertible debentures. What are the equivalent equity shares? If the conversions is not fixed upfront, then what could be the maximum number of shares which could be allotted? Why it says maximum, why not minimum? Because what the law is, if you have given somebody an instrument today based on current valuation, and at the time of conversion, the valuation changes, assuming, the benefit of valuation should not be given to the foreign investor, but should remain with the Indian company. Example, today my share is priced at 100, valuation. I take 100 rupees from you and I will issue one share, maybe at premium or not at premium. Tomorrow, when I actually convert, the fair value becomes 50 rupees. It may I have to give 2 shares. I can't give. I can give only 1 share. If it becomes 200, I'll give half of share, 50%. This is what the FEMA provides very specifically, that if you give anybody an instrument today, which is to be converted in future, then valuation has to be decided and confirmed upfront, not futuristic. If you do it based on a futuristic valuation, then you can issue only that number of shares or lesser than what he has agreed as of today's price, not more. Next is share warrants. Equivalent considering 100% exercise, because share warrants valuation are always finalized for a listed company. It is only that you get 18 months to 12 or 18 months to subscribe. ESOPs, you give ESOPs, you have vested ESOPs, but those are not exercised after when you become eligible after 3 years or whatever time. But you have issued ESOPs. So there is a specific requirement. If you issue ESOPs to a non-resident, you have to file a separate form on the firm's portal. And when you allot shares later on, then you have to link that FCGPR form with that ESOP form. Only then you can go ahead. Otherwise, there is a compounding. Otherwise, there is a contravention. To report only capital instruments on a repatriation basis. It means when we come to Schedule 4, NRI OCI on a non-repatriation basis, those are not to be discussed or considered for the purpose of dilution basis. Then you have foreign portfolio investment, FPIs. FPIs is, as I said, it is SEBI registered for foreign portfolio investor. Then you have foreign investment. Foreign investment means any investment made by a person on a repatriation basis, equity instruments. That is the crux of the issue. And if in certain cases, you see, you have this beneficial ownership, especially in case of a 100% subsidiary of a foreign company in India, you have to have 2 shareholders minimum. In a private company and public company, you have to have 7 shareholders. So what we do in India, if I incorporate a whole subsidiary, I will give all shares to whosoever owns it otherwise, and then I'll give 1 share in case of private company, or 6 shares to those 6 individuals or whatever to make it 100%. Similarly, under FEMA also, they have captured this issue that if somebody is a nominee of somebody else, beneficial ownership is with the other person, the payment is made by the beneficial owner, but the shares are allotted in the name of beneficiary, that also will be treated as FDI. If there is a change in the nominee tomorrow, then only filing is required. There are no forms, etc. required for the purpose of reporting. So this is, from that point of view, I have covered it. Then what is equity instruments? Equity instruments are equity capital, including partly paid up shares. Partly paid up shares are also equity share capital. Then you have convertible debenture, as I discussed, preferred shares, share warrants. Share warrants, what is the condition? That 25% must be received upfront, and the balance can be in 18 months, not beyond 18 months. This is as per the CB regulation. And if you have an optionality clause, then you have a minimum lock-in of 1 year. If you give futuristic valuation, you want to do it, then that is also possible. Then partly paid up shares must be fully called up within 12 months. This is under FEMA, under FDI regulation. But is there any regulation under Companies Act? If we talk about parallelly, there is no regulation under Companies Act as to in how many months and years you have to make it fully paid up. The rules only, company rules only say that you can't get more than 25% at one go, and there are some 30 days, etc. So, but if you are issuing share to a non-resident, then you must follow FDI rules. If you are issuing shares to a resident, then you are not to follow FDI rule, you can follow Companies Act rules. When I say 25%, it includes premium also. If I am saying 10 plus 90 is 100, 25% is 25 rupees. It is not only of nominal value, 2.5 rupees, 25 rupees. So this is how it will be done. And in case of a listed company, they are given a dispensation under the SEBI regulation, ICDR, that if you want to do it in more than 12 months, then you have to have a monitoring agency which has to report to SEBI regularly. And then in case of unlisted company, they said that is also possible. In that case, you appoint a AD bank as your monitoring agency. And you see these two paras are there only in the master directions. They are not in the rules and regulations. It means sometimes you will find a substantive law or an important law in the master direction, not in the rules and regulation, and vice versa also. Sometimes something covered in master directions, in rules and regulations, you will not find it in the master direction at all. Then in the case of non-payment, of course, it is a forfeiture as per the Companies Act, and there are no prohibition under FEMA if you forfeit unpaid shares. Especially in case of IPO document wherein non-residents or NRIs have also subscribed, but they are not paid later because of share price has come down or whatever is the reason, right? Then you have convertible debentures. Here, as I use the word, fully and mandatorily convertible debentures. If they are not fully and mandatorily convertible, if they have anything other attached to it, partly convertible, non-convertible, optionally convertible. So those are not equity instruments. They will not be covered by FDI policy. They will be governed by ECB guidelines, which is borrowing and lending regulation, not FDI guidelines. Similarly, for preference shares, if they are not fully mandatorily convertible, if they are redeemable, partly optional, etc., then you comply with the ECB because they are treated as loan for the purpose of FDI, or a debt, not as an equity instrument. That is where they use the word equity instrument, not equity share capital. Before 19, they used to call it capital instruments. Now they have changed to equity instruments, and now equity instruments, they have said these are the instruments which are equity or equivalent to equity, like CCD, fully mandated debentures, share warrants, and ESOP. They are not equity, but they are in the nature of equity at some later stage. Then sometime an issue arises, if I change the tenure of preference shares or tenure of NCD convertible, then what happens? Because Companies Act is allowed 20 years you get under preference share and 30 years for infrastructure, and the debt also, there are rules that if you do it within 10 years, so there are rules for NCD, and then in the deposit rules, they have mentioned what is the deposit. If it is fully secured deposit, it is not a deposit. Debenture. If it is not a secured debenture, then it is a deposit. So there are different, I'm just comparing with FEMA and this thing. So they say, so long as you change the tenure and terms and conditions as are applicable under the Companies Act, we have no problem. You can do that subject to a condition that overall it must match with my FEMA guidelines. FEMA has not prescribed for number of years you can keep your convertible instruments open, like debentures and preference share, but they have said warrants 18 months, partly paid up 12 months. And ESOP is also again not an instrument which is not an equity instrument today, but it becomes instrument only on exercise and allotment. Then you have government approval. As I said, you anything not under automatic route, you go to government through that Parva portal, which is DPIT portal, and then respective ministries and departments look into it. Then there is a definition of group. 2 or more companies are classified as group companies if 26% of voting rights is exercised by the other enterprise, common, and then there are more than 50% of members of the board at other enterprise. So this is picked up from FTP, Foreign Trade Policy. It is not picked up from Companies Act. So here you see the difference. Somewhere they are talking about nominal shares. Here they are talking about voting rights. Then they are talking about members. So each and somewhere you'll find a lot of variation in the FEMA itself in terms of the terminology, in terms of what you have to analyze and what you have to understand in terms of arriving at that threshold, whether it is a nominal capital, whether it is a paid up capital, whether it's a voting rights, or whether it's something else. So they are very fine differences. So if anybody interested to understand more, that we can discuss after lunch if I am here for some time. And then company, investment company is all companies basically. Then Indian company does not include, which are those? Society, charitable, cooperative, whatever society, registered or unregistered under Maharashtra Act or even the State Act. Trusts, private trusts are not covered, charitable trusts are not covered. Indian trust tax does not apply. Or any entity which is excluded specifically. Trust is only allowed in case of InvIT, ADVIT and AIF, but otherwise trusts are not allowed. Investment repatriation basis, as I said earlier, that it is, if you can repatriate income, capital gains and everything, so that is repatriable, otherwise reverse is non-repatriable. And how this is important? Company definition is important for wholesale trading in the whole FDI document, not elsewhere, because if you are into wholesale trading, then you cannot sell through your own group company more than 25% of the wholesale turnover, right? So this is important from that angle, not otherwise. Otherwise, nowhere else you find the place. Manufacture is also a definition which I think picked up from this GST and custom rules, more or less same. And we understand what is manufacture and why this is relevant. This is relevant because in the sectoral policy or activity, it says any manufacturing is under automatic route unless there is a specific restriction or regulation under the sectors which are eligible. Second is, I will give you a very, very thin line of difference between manufacturing and toll manufacturing or third-party manufacturing. So people feel that manufacturing means my own manufacturing in my own manufacturing premises. If I get my goods manufactured in another person's premises, either under toll manufacturing arrangement or third-party arrangement, which is generally we find important for transfer pricing or transfer pricing, there are various regulation rules on these toll manufacturing and third-party manufacturing. So here, what the law says, my own manufacturing, 100% automatic route, third party and toll manufacturing, if it is through an agreement, written agreement between the two parties, the vendor and the buyer, wherein it says that you manufacture on my behalf for me, raw material I may give or may not give, you use the raw material and do it under my branding, my thing, and that what you produce is meant for me only. You can produce that for somebody else also, but when I give you an order, specific order, it is for me under arrangement, so that is also treated my manufacturing. If it is my manufacturing, I can do retail. I can do B2C, I can do e-commerce inventory model, right? But if it is not termed as manufacturing, then I can't do. I can't do retailing, I can't do B2C, I can't do e-commerce. So, but if I do it through a third party under an arrangement, principal arrangement, then that is termed as manufacturing. So this is a very important difference to understand, which I will cover in separate slides in 3-4 instances. Then non-debt instruments, which is not our subject matter. This is, yes, we are talking non-debt only, which is equity instruments, and which is capital contribution in a LLP. Then you have alternative investment funds, AIFs, REITs and InvITs. Then you have units for mutual fund, ETFs, then immobile property, and then contribution trust with these trusts, and then the depositories. So this we have already discussed. Then NRI, I think you have understood, I will not discuss on that. NRI means Indian passport holder staying abroad. OCI is a foreign passport holder of Indian origin, which is called OCI. And there is another thing called PIO, person of Indian origin, because this has been substituted by OCI. But those PIO card holders, which were earlier having PIO card holder, they were given time every 2 years to convert it into OCI card. Those who have not done it, still they are allowing it. So PIO card holder even today are allowed to have same benefits as you have for OCI card holder. So what are the benefits? I think if we get time, I will discuss about that in the end, not otherwise. Resident Indian citizen. You must have been told in the first lecture or maybe the other lecture on residents that citizenship is not important for the purpose of defining if you are non-resident or non-resident. Citizenship is important only from one regulation in the whole FEMA, which is downstream investment, indirect investment, not otherwise. or it is in a specific sector under insurance or under banking, but not normally. Normally it is only under downstream investment. We will discuss about that later. Sectoral cap. Sectoral cap is foreign investment on a repatriation basis, which includes indirect investment also, which is a composite limit covering all this thing. Then TDRs generally TDR is prohibited. So I also wonder, what is TDR? What is transferable development right? It is given by a builder or it is given by somebody else. They say no, TDR which are given by central state government, those are called TDR. In that you cannot deal, because otherwise it is a real estate. And units means units of any mutual fund or investment vehicle. And this is another important term, FDI linked performance conditions. What is the meaning of FDI linked performance condition? It means in the NDI rules where you have schedule 1, you have this sectors and activities. So under each activity is they have mentioned some conditions also attached to it, that you can do it like agriculture, plantation, real estate, telecom, banking, insurance, etc., etc. So if you have FDI linked performance condition, then those sectors are not open for LLP investments. So this is linkage in LLP, not in FDI company. It is for LLP. So what are those? I will discuss that. I have given some small line here. In Schedule 6, LLP Schedule 6 basically, it says retail, not wholesale, agriculture, plantation, print media, real estate, and NBFCs. Because there are some performance conditions into these. So that is why it is not permissible. Otherwise, all other sectors, it is not termed as performance linked for the purpose of LLP. Different professionals have a different view on this. Some people say that everything given in that schedule is all performance linked. But the practical, what I have done and what I have spoken to RBI people and banking, etc., these are the 4 or 5 sectors wherein they consider, otherwise they don't consider it. Then there is an important definition called controlled. When we come to indirect investment, we talk about ownership and control, owned and controlled. Owned is equity capital, right? Diluted means nominal capital, right? And what is control? Control is not through equity. Control is through right to appoint majority of directors. It means you have majority shareholder, majority voting rights. It means you have a right to control board of directors, directly, indirectly. So this is a peculiar case in case of partly paid up shares. Partly paid up shares, the partly paid up shares get right voting only to the extent of paid up capital, not complete. So this issue is coming in one of my clients' case, that if I issue partly paid up shares to an Indian resident and I keep it partly paid up for a year or 2, then will my company status change? So the answer is, there they talk about nominal capital, somewhere voting rights, so that has to be seen from that angle. Control means board of directors, and then, this is very important, control the management or policy decision exercised by person acting or individual in concert. This terminology is drawn from SEBI regulation. It is not in the Companies Act. Directly or indirectly, including by virtue of their shareholding or management rights, shareholder agreement, voting rights in any other manner. It means this is open-ended. Take a case of a PE fund investing 5%, then having a 1% on the board, and then having some veto rights and some affirmative rights, 30-40 items that you can't do certain things without the consent or without the written consent of our nominee director, and then JV partner. When there are more than one JV partners, like in case of listed companies, you take few cases. Think of few cases like Airtel. You have a Singapore. You have some other promoters also. Then how do you do it? So this control definition is very simple, because this is borrowed. Now this definition is equivalent everywhere. It is under Companies Act same, FEMA same, SEBI same. So this is same now. Most of the places where we interact. Yes, eligible investor, they say that if you are a resident of India, Nepal and Bhutan and a company of citizens of Nepal, then you cannot invest in Indian rupee, because otherwise it is allowed. You do it only in the foreign, in a free foreign exchange. And a company, trust or partnership firm owned and controlled by NRIs can invest under Schedule 4 for that NRI dispensation. It means NRI himself as an individual, and plus any company, trust or partnership firm abroad wherein NRI together holds more than 50%. Owned and controlled, balance can be by other non-residents. They can be foreign citizens, they can be foreign companies also. They can invest under Schedule 4 on a non-repatriation basis. Then trust, as I said, trust is not allowed other than venture capital funds. And then this is a small conversion of LLP, which is permissible. Vice versa is permissible if there are no performance-linked conditions. Otherwise, any other sector, you can convert LLP with FDI into company and a company with FDI into LLP. Then this is a China issue, which I will not spend much time on this, that if you are coming from these border states like Pakistan, Afghanistan, China, Nepal, Bhutan, Bangladesh, and Myanmar, and China includes Hong Kong and Macau. This is final word now from RBI and AD banks. People generally get confused whether Hong Kong is not land border, how can this be? But this is a final word now. And it says that if they want to invest into Indian company, directly or indirectly through a beneficial owner, SBOs we call it under, as we know under Section 90 SBOs. So they cannot do it. They have to take government approval. And it came during COVID days because Chinese companies were buying shares of listed and unlisted companies in a wholesale manner. So the government stopped, and even now after 6 years now, I think not many approvals have been given for China. Now this government has come up with this new circular in 17th April. Under FEMA, they have not notified this circular, so it is still hanging fire, but it will come at any time. It says any citizen or any entity which has land border with this company can come under government rules. Pakistan, of course, is not allowed in any case. Bangladesh is also under government approval route. This applies not only to fresh investment, it even to transfer of ownership, directly, indirectly will also cover. ESOPs are also covered. And the beneficial owner, now they have said that what is the beneficial owner is defined now as per the PMLA, Act and PMLA rules. Earlier, people were drawing references from either Section 90 of Companies Act, or they were drawing inferences from other regulations on beneficial ownership. Now they said that we will follow the definition under PMLA and rules, but the threshold is 10%. PMLA is 25%, but they say it is 10%. Then there is some write-up on this. I'm not going through it because we people generally don't deal with it right now. And I skip it, you read it, I think you will understand it, right? So this is now coming to sector specific, what is allowed, what is not allowed. So these 5 sectors are fully prohibited. What are those? Lottery business, government or private, online. It says etc. 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 means anything related to this is prohibited. And how do you interpret it? I think your own interpretation, anything similar will get covered. And there are many court judgments also on gambling and lottery business. I think we have to refer to that, but ultimately it says etc. means anything concerning gambling not allowed. Gambling and betting, including casinos. And those companies which were there before 1991, so they are still continuing, right? Otherwise, later on, they are not allowed. Nidhi and TRD and real estate and construction of farmhouses. Real estate, we understand. Farmhouse generally is a term which is loosely used in the common parlance. Farmhouse is my farmhouse. That's not your farmhouse. Farmhouse is a specific term under generally a state law. It is a state subject. So they define which part of the state, which territory is a farmhouse. So they will issue for at the time of allotment, at the time of registry, they will call it farmhouse. So like I'm from Delhi, so I know Delhi and UP. So there they have specific words called farmhouse in the municipality policy, and in the local state policy, they look farmhouses. So now what they have done, the big farmhouses which were there for many years and they were all converted into residential houses. Now they are calling it in Delhi now, last 2 years now, low density residential areas. They're not calling farmhouses. It means an NRI which is prohibited to invest in farmhouse. I think we had immoral property yesterday. The farmhouse is not allowed for NRI OCI. So very differently they have deleted farmhouse. They say low density residential areas. So now I say I can now invest in this. I said yes, you can, because it is changing terminology. And similarly in UP also, UP of course everything is leased. There is no freehold like in Delhi and Bombay. So there also in big Noida authority allotment, they say farmhouse. If it's a farmhouse, it's a farmhouse. Whether it is used for industry or whatever material. If they don't do farmhouse, then it is not a farmhouse. So which is prohibited. Then what is real estate? Real estate is, I have separate slides for that, but broadly what it says, with a view to earning profits, but does not include development of township, construction, residential, commercial properties, excludes real estate broking, REITs and rental, etc. from a constructed property. The simple question here is, which people struggle and we have different answers. Can I buy and sell? Answer is no. Can I buy and lease? Answer is no. Can I construct and lease? Answer is yes. Can I construct and sell? Answer is yes. So I have given a table which will come to later, right? And then tobacco substitute is also not allowed. Manufacturing, it says only manufacturing. Others, if you see, they have not mentioned the activity. It says the sector, lottery, gambling, real estate. It says manufacturing of cigars and tobacco products. Is trading permitted? Answer is yes. There is an RBI circular on this long back, I think 1211, which has said that tobacco manufacturing is banned, but tobacco trading is allowed. Then activity is not open for private sector is atomic energy and railway operations. Some part are excluded, which is given the policy, which are not abstracted here. Then last is very important, foreign collaboration agreements. What are foreign collaboration agreements? Some people who are dealing with clients who have FDI. So every year RBI asks for a statistical information on foreign collaborations. Every year, sometime April, May, they come and you have to file it. So they also use the word foreign collaboration. So people ask, what is foreign collaboration? It is equity participation, it is a technology participation, it is a trademark, or it is, what exactly is foreign technology collaboration? Earlier, I think, prior to 2012 something, it was all under regulated, that you were not allowed to give royalty and beyond 3%, 5%, and not technical law. That all has gone now. It was part of the current account transaction rules. So that all is gone. But what they have not withdrawn is foreign technical collaborations, including licensing of franchise, trademark, brand name, management contracts in lottery and gambling, which is still prohibited, which is generally not a case here. So I am skipping only for this part. Then permitted, I am talking automatic. Automatic means automatic. You just bring in the funds into India, file necessary forms with the AD bank, and then you get on the forms portal, you get acknowledgement. Thank you very much. No approval, nothing required. And what is government rule? Government rule, I said that, but it is not automated under government rule. Government rule is through that Parva portal. And if the FDI is more than 5,000 crores cumulative for that company, then you have to take approval of CCEA, which happens once in 3 months, once in 4 months for a very large project. Otherwise, it is not there. Then I mentioned that how do you do it? And if it is so, then MHA, Home Affairs, also comes into picture, which takes a lot of time in giving approvals. And especially in those sectors like broadcasting, telecom, satellite, private security services, defense, civil aviation, mining, and maybe a few more, but this is what I have. Then sectoral caps. I will come to that chart. It says anything not listed, it is permitted. Then there is an important aspect of financial services. What is financial services? Generally, we get our common sense as chartered account, we say NBFC. Anything financial is NBFC, we say, right? But NBFC is an offshoot of RBI regulation. It is not from Companies Act or not from FEMA. NBFC is one of the financial service activities because it's a company, NBFC. C is a standard for company. And can other than company do non-banking banking financial services? So that is defined under RBI Act, Section 45 IA. So that I am not discussing, but generally. So then minimum capitalization, how to calculate, I am just skipping it. And then investing company is an important definition. But it says, can I invest in an Indian company, FDI, whose business is investing into downstream companies, money as buying and selling, including stock exchange? Answer is no. You can't do it. You have to go to, you have to take prior permission of government, which generally is not given. Then these are few slides which I will pass through a little faster because I have abstracted it from the NDI rules, just to give you a glance so that you can relate it that these are the places where there are some restrictions and consideration for under FDI policy. And in certain of these, there are some more notes here which I am not I'm abstracted where it is necessary. So there are many. I will just skip through it a little faster. You can read the law later. What it say? Agriculture and animal husbandry. It is 100% automatic. In which sectors? Following sectors: floriculture, horticulture, cultivation of vegetables and mushrooms under controlled conditions. What is the controlled condition given in the next row? Term under controlled condition covers the following: cultivation under controlled condition of the category of floriculture, horticulture, vegetable, mushroom, cultivate where rainfall, temperature, solar radiation, air, humidity, culture medium are controlled, artificially controlled parameters through effective cultivation under greenhouses, net houses, polyhouses, etc., that is allowed. Development and production of seeds and planting material, not for sale as a commercial product, but as a seeds only. Animal husbandry, including breeding of dogs and pisciculture. Then services related to agro and allied services, which is under automatic route. Anything else under agriculture is under more or less prohibited sector. You don't get approval. You don't get approval because generally a question comes: if it is not given there, can I get permission, either from RBI or from government? My answer to that is categorical no. People say, no, let us try, go to RBI, go to bank. It doesn't happen. If a stated policy say you are allowed to do 1, 2, 3, thank you very much. If you're not gone for approval, you go for approval, they'll give you 4-factor approval. But no government, no authority will give you permission for 4. Not at all, 0%. So just forget about it. But there will be a lot of people who say, I will try, I will give, nothing happens. Yes, sir. नहीं हॉर्टिकल्चर में ऐसा है, फ्लोरिकल्चर हॉर्टिकल्चर क्या, इट शुड बी अंडर कंट्रोल्ड कंडीशंस. इट मीन इट शुड बी अंडर ग्रीन हाउसेज, नेट हाउसेज, पॉली हाउसेज एंड अदर इम्प्रूव्ड इंफ्रास्ट्रक्चर. इट मीन इट कांट बी ऑन द ओपन लैंड. हाँ, दैट इज नॉट अलाउड. So on horticulture, if you want to read more, if you are practically interested in that horticulture, you read a paper by Ministry of Agriculture on horticulture. There is a specific department on this, so they have come out with a note on what is horticulture. So I think you will get an idea from there. And then you have plantation, tea, including tea plantation, coffee, rubber, cardamom, palm, olive oil. Anything else not allowed. Not allowed means not allowed. Mining is 100%, 100%. The only last category is 100% under government route, otherwise not allowed. What is that? Mining and minerals, titanium, etc. I am not going through these because we people don't deal with, so I just skip only for you understanding that there is some law on there. Petroleum and natural gas, it is 100% automatic, and PSU is 49% automatic, otherwise not. Defense, 100% cap, automatic up to 74%. Balance for that you have to go to government, and that permission will be given only if only very, very high tech, otherwise generally not given. There are few approvals in defense, but not many of this. Then you need licensing from Ministry of Defense, and there they have listed out, there is a big manual, what is allowed, what is not allowed. So anybody interested can read that manual. Then broadcasting is like setting up, uplinking, actual teleports, etc., etc. They see 100% automatic, 100% automatic. Last 3 rows is 49% government, FM radio. Then uplinking of news and current affairs, TV channels, 49%, again government. It means if 1% need government, beyond that government doesn't give permission. Uplinking non-news, if you're non-news, then it is 100% automatic. News is 49% with government, non-news is 100% automatic. Print media, newspaper, periodical, 26% government approval. Journals, foreign journals, 26% government approval. Otherwise, 100% government approval. Otherwise, if it is non-news, then it is 100% allowed. Civil aviation, same is there. Greenfield, 100%. Existing project, 100%. Scheduled air transport service, 100%, but 49% under automatic route. And if it is NRI, then 100%. Like this Jet Air, Jet Air was owned by NRI, Mr. Goyal, so it was 100% at that time. And then non-schedule is 100%, like you have these helicopters and people having the private charter flight, so they're all 100%. Then ground handling 100%, maintenance 100%. Then this is important part. I think we'll spend some time on this, as I was told by Jay that spend some time on real estate. So what is real estate? These terminologies are as it is from the law, nothing added from my side. Construction development projects which shall include development of townships. I think after this we will take a break. Whatever time it takes, I don't know how much time it takes. Because this is interesting for all of us. Construction of residential, commercial premises, roads, bridges, hotels, resorts, hospitals, education institutions. What it says, development and construction. It is not running of hotels. It is not running of hospitals. It is not running of education institutions. If in the process of running a hospital or a hotel or education, you are doing construction for that construction is not part of real estate. That is part of running a hospitality sector or a hotel sector or education institution. So that is not covered. Only if you are doing construction activity, then only there are some regulations. Otherwise, for running that institution, nothing is required. Then what it says, let us read one by one and understand the implication there. Each phase of construction project shall be considered a separate project. You have complex, you have 5 towers, you complete 1 tower with common facility, that is treated as one project. Second tower come 2, now 3, 4. But not that you construct one and there are no facilities for common facility, there are no entrance and there are no water supply, etc. That is not be covered. If that single projected phase is independent in terms of it can be occupied, you get a completion certificate from the state authority, then it is termed as a separate phase, and that is complete. Why important? Why this is important to understand? I think in the subsequent panel you will understand. The investor shall be permitted to exit. Investor means foreign investor. On completion of project is each phase of construction development, right? Or after development of trunk infrastructure, which is road, water supply, street lighting, drainage and service. This is important for service projects, service plots. Because service plot, you don't construct building as such, you have service plots. Then once you identify and earmark, and then you have this facility, this is termed as completion, trunk facility. Not with any standing B above. It means even if it is not complete, even if trunk facility is not complete, then what happens? A person resident outside India shall be permitted to exit and repatriate for investment before the completion of project under automatically provided lock-in period of 3 years calculated with reference to each tranche of foreign investment has been completed. Further, transfer of stake from a person resident outside India to another person outside India without repatriation of foreign fund will be subject to lock-in period, will not be subject to lock-in period or government approval. Means what? That is split into 2 parts. Non-resident has made an investment into a project which is a approved project, which is eligible for this FDI. Somehow it could not be completed. Then what do I do? It means I have no right to exit, which happened earlier because this was changed I think few years ago. Earlier it was that you have no right to exit. You go to government will not give permission, RBI will not give permission, so you are stuck. So you do all kinds of maneuvering, all kinds of understanding here and there, but nothing would succeed. Now they said that if foreign investor has come, and generally you are into real estate development. Not that he has come, you bought a land and then you appreciate and then you say I want to go after 3 years. You should have taken effective steps for the real estate development. This is important factor to understand, which people generally omit. Question is not that if I have put in money, I have started a project, it will 100% be completed. It never happens, especially in the real estate of the last 8-10 years. No, you see wherever I go, I find a lot of building standing half complete, 70%, and like that. In every state you find this. So the point is, how will the foreign investor exit? He can't exit. So they have given option now that if you have taken effective steps and there are documentary evidence to say that you had started the project, it could not be completed for whatever reason, and he wants to exit, let him after 3 years. Of each tranche means each investment coming to India. If I have put in money today, 100 crore today, 3 years from today. If put in another 100 crore after 1 month, the 3 years will start from that date. Like that, it will be from the each tranche date of inward remittance. You can exit. Then it may so happen that non-resident is transferred to another non-resident, right? Not in India, because I say there is no repatriation. If we transfer from a non-resident to resident, then of course there is a repatriation. There is another repatriation. They say that also is permissible on the automatic route. That is permissible even before 3 years. It means the initial investor, foreign investor, has not to wait for 3 years to transfer. If somebody else is coming into his steps to acquire shares outside India, that is permissible under the automatic route. Then it says the project shall conform to norms and standards of the municipality and state law. That is very clear, because everything you have to take state government approval. And then what is it called? IRDA we call it, that authority which monitors real estate. And then it says that the investing Indian company permit to sell only developed projects. For the purpose of developed projects shall mean trunk facility. It means I have taken FDI for an investor, and then what happens? If I started a project, I have announced a project, then I start marketing, I say that it's available, and then people start giving you money, right? In installments or one time, whatever, I'll complete it in 3 years, 5 years. So what it say, an FDI, if you have FDI in that company, you cannot sell the project. You can receive advance money based on the future construction, but you can't sell can't sell the unconstructed project. It means you can't sell and then make money and then repatriate profit abroad by showing profit in the balance sheet. It means you cannot do it unless it is fully complete. This is a very important aspect. The investing company shall be responsible for obtaining all necessary approval. That is fine. State government will give compliance conditions. Then not permitted, as I said, in farmhouse and trading TDR. This is important. Conditions of lock-in period shall not apply to hotels, resorts, hospitals, SEZ, economic institutions, old age homes, and investment NRIs. It means NRIs and OCIs, if they invest under real estate, under FDI, they are coming under FDI, because any individual, whether is a NRI or non-NRI, a foreign citizen also, an individual can also come under FDI. Generally, people get confused that if FDI has to come, it has to come from a corporate structure, some entity. No, not that. Even an individual who is a foreign national can also invest in the individual capacity. NRIs, of course, can invest under different schedules, like Schedule 3, Schedule 4 also, and they can also invest in their personal names, right? So that is a different regulation, investment of NRI in immovable property. But in case of hotel, tourism, hospital, it is not applicable, because then you are not into real estate development as such. Completion of project is as per the state laws. And foreign investment, this is important. 100% investment percent is allowed in completed projects for managing malls. It means if it's a completed project and you acquire that, like in Bombay, this Blackstone has acquired a lot of built-up properties. And if there are malls and shopping complexes, you buy that and you run that. You don't sell it. You run it like a normal, you run a mall facility. So that is also permissible. They call it in the business center, and they're not calling it real estate development. They say not calling it real estate activity. They're not into buying and selling. They are buying a property and then they are using it as a business center or a complex for the purpose of getting rentals overall, not as a particular renting a premises, but overall building as such. So that is also permissible. And then this is a chart what I have discussed with you. Buying and lease commercial permitted only as a business center, not otherwise. Buying and lease residential not permitted, rental housing. Construction and sale permitted, subject to lock-in. Construction lease, it is also permitted. Construction services, if I am only a contractor for construction of building, that is permissible, because that is not a real estate development. Warehousing and logistic infrastructure, that is covered by infrastructure. Logistic infrastructure, for that there are conditions that like cold chain and food chains and those warehouses. But condition is minimum investment of 15 crores, minimum area of 20,000 square feet, and warehousing facility with minimum 25 crore, minimum 1 lakh area. Hotels and resorts as a service, broking is also allowed. Co-working, co-living also allowed. Property portals allowed. Trading in real not permitted. And this is another comparative summary. So this is more or less talking about the same thing, excepting that it has added SCG development 100%, industrial parks 100%. So these are two extra which is included here with some conditionalities. And then industrial park I have covered in the previous one, but this is also covered 100% automatic, subject to the condition mentioned here in that third row from the top, minimum units, 10 units, 60% industrial use and state policy. And then you have space sector. I'm not discussing specific. Then this is important part. Private security agencies, 49%. People had come into India with the 100% sector, so all they have now reversed. It's only 49% because of a security concern. Telecom is 100% today. Automatic manufacturing, as I said, is 100%. I think I will read this for you. Manufacturing activities may be either self-manufacturing by the investing company or contract manufacturing through a legally tenable contract, whether on principal to principal basis or principal agent basis. Further, manufacturer is permitted to sell his products manufactured in India through wholesale retail, including through e-commerce without government approval. It means own manufacturing and third-party manufacturing, toll manufacturing is also allowed under all these conditions. Then 100% manufacturing, 100% foreign investment under a government route is allowed for trading in food items, which I will discuss later. So I think I stop here. Trading I will discuss later. I think it's 10:30 now sharp. Thank you. So we break for some time. Starting now. Yes, go ahead. So we were on this last slide of manufacturing. So manufacturing includes third-party manufacturing. This is an important understanding. Then we are into trading now. So trading is divided into 4 or 5 parts. One is a cash and carry wholesale trading. Cash and carry is not important is wholesale trading. And 100% automatic route with certain conditions that to whom you can sell to classify as a wholesale trading. Thumb rule is that if it to an end consumer, it is not wholesale, it is a retail. If it is not an end consumer, then it is some intermediary coming in between, it becomes a wholesale trading. And if it directly to end consumer, it is retail trading. So what they have defined, if you are selling through retailers, industrial, commercial institution, other professional body users, other wholesale retail subordinate services, then it is termed as wholesale trading. Even in canteens or office canteens in a manufacturing company, if they buy from a supplier in a quantity which is not retail, it is irrespective whether you buy 5 items or you buy 500 items are not important. Invoice value is not important. Important is basically that you are not end user and you are somebody else. It means I am intermediary, then it becomes a wholesale trading. It is a not size and volume, it is not important. Important is resale, processing, and thereafter it is okay with this. And what they say, the requisition is that there should be license, registration permits given by any government authority and business customers, and if it's a GST registration buyer, that is also termed as an intermediary, and holding a trade license and under Shop and Establishment Act, permit to license like Tehbajari and hawkers, that is also not retail. And even societies registered and public trust, if they buy not for their own consumption but for the member, that is also wholesale trading. And what is important is that the entity which is involved into wholesale has to maintain full records of wholesale trading, and not more than 25% of the total of the wholesale venture should not be to group company. People generally get confused that 25% of total turnover, not total turnover. Turnover may be other than wholesale trading also. If I am into wholesale and I am also manufacturer, if I am manufacturer, I import also and I sell also, like many companies do. So only trading part, that is wholesale, that is important, not the whole turnover of the entity as such. And if some entity is having both wholesale also, a single brand also, so both have to be separately complied with and separate records ought to be maintained. What is single brand? I will come in the next slide. And this is a single brand. Single brand means you have a registered brand. It may be Indian brand, it may be foreign brand. It may be the brand owner himself or itself doing it, or maybe it is giving, licensing it as a licensor to somebody else in India, and that becomes a licensee and he's using the international brand. International brand means more than one country. It should not be a single country, it can be more than one country, so that is called international brand. And here the important issue is how much percentage, 100%, automatic. No need for any approvals, excepting that if you are more than 51%, then 30% of the value is to be locally sourced. Locally sourced means locally sourced of the same item which I am selling, or anything is possible. The answer is anything is possible. I am selling watches, Rado watches. I can't locally even buy any material for it to become a finished product. So what they say, 30% of the total value you source from India and let you export it. And 30% sourcing can be done also by a group company in India, not necessarily that you do it as an entity, because if I am selling a Rado brand in India and I have an entity, it's not that any of my affiliate can also buy from India 30% of that and then export it. So that is also termed as a local sources, which is quite interesting, looks like ordinary, but this is what the law says. It says, meeting local sourcing requirement, procurement made from India by the entity, the single brand shall be counted towards our local sourcing, or sold in India, exported, etc., etc. That I have covered with you. And then it says that once you do it, you have to, if you want to do it through a retail outlet, which they call brick and mortar stores, you can do it through them. And the Indian brand should be, and the sourcing, it says, if it's 51%, it is not applicable for first 3 years of commencement. After that 3 years, you can do it. As specific clauses, I'm not going it because this is not, very people are not doing it. Multi-brand is under government approval 51%, which is multi-brand, fresh agriculture produce, fruits, vegetables, flowers, grains, pulses, fresh poultry, fishing, etc., which is produced in India. If you import and sell, then it is wholesale trading, that is not covered by this clause, and retail sale outlets is also permissible. Some countries have given yes to it, which is given the last row, Andhra Pradesh, Assam, etc. But there are not many approvals given by government on this. So now this is an important part, which is e-commerce. E-commerce is what? If it's a B2B, business to business, then it is permissible there. It's called like a wholesale trading, so it is not there. If I am selling my products which are manufactured by me or by other person, that is also not part of restriction. It is a marketplace and inventory base. Market base means I am using my portal for the purpose of getting orders and then supplying, like Amazon, Flipkart, these companies, and including Blinkit now, as we call it. An inventory model is where I also have an inventory which I sell through my own invoice. So how to find it? Very simple. You go to the site, purchase an item, and see whose invoice is this. If this invoice is of the same person who is having FDI, then it is he is involving into e-commerce himself. If the invoice is through a third party, some intermediary has come in between, then that is not e-commerce, because the inventory is by somebody else. So I am only allowing people to use my e-commerce facility, which is called marketplace, and wherein payments are handled through the payment portal, etc. So I am not into inventory model, so that is permissible, that is not an issue. So this is a slide which we say B2B is 100% allowed, marketplace is 100% allowed, inventory based model is not allowed unless it is your own manufacturing. Then it gives lot of conditions, how to do it, how to verify it, all these things. I am not reading it, so that these are not that important to understand. I think once you read the law yourself, you'll understand how to implement it. And there are a few slides now on how people are doing it, how people are circumventing this, not circumventing, how people are using the policy to their benefit, wherein they achieve retail also, but at the same time they are within the law of the land. So here if you see, the first box is wholesale trading. Foreign investor has invested into it. It can be foreign 100% also, it can be Indian also, there is no issue because there is no percentage prescribed. Then it sells goods below it to a retail front lending, right? And then on the right hand side you have retail is prohibited. So you have online portal where you supply from the wholesale trading to the customer, and retail is not coming in between because that is owned by an Indian investor, because retail is not even 1 rupee allowed. So what they do, they in between put a retail entity. On the top they have wholesale entity. Wholesale entity keeps the margin, more than 100%, and some margin is given to the retail entity who keeps, that much of margin which is good enough for it to meet expenses, and some profitability as we do it in transfer pricing for analysis based on risk analysis. You give some margin here, 2%, 5%, then this is simplest method which is achievable. Second is that you have same more or less, excepting that you have marketplace. It means marketplace means your order is coming on the right hand side below marketplace, where the order and payment is coming, and then it is going to the retail. Customer is supplied directly by the wholesale company, not by the intermediary retail outfit. And the order and payment is coming from the customer to the marketplace company, like you have Flipkart and Amazon. Yes, sir. Say again.
B2C sale is not permitted, right? But when we order something from Apple's website, the Apple India Private Limited invoice came. So I think Apple India Private Limited is wholly owned by the Apple Incorporation USA. So how they can do it then if a B2C is not permitted? Like if I am ordering iPhone from the Apple website, then the invoice came in the with the supplier name of Apple India Private Limited.
I'm not aware of this how happening. The law is that, just see from which entity the movement of goods happening. Who is keeping the inventory? Inventory is kept by this Indian entity which is a subsidiary of Apple US, or it is kept by somebody else. Who is the supplier of inventory to you?
Recently, Apple, I think in last 2 years, Apple had opened 2 stores of their own in the name of
Right.
Apple India Private Limited, and they are doing B2C sales in their name. So, and I think Apple India Private Limited must be wholly owned by the Apple Incorporation USA.
That I have not analyzed, but point is that if I assume that Apple India is importing goods, because this all importing Apple mobile, say, into the Indian company, it's like import of goods and then selling it to end consumer. This is not permissible. There may be some other catch in between. I am not aware of it.
Or if they are producing in India, then
it's okay, na? If it is manufactured in India, then there is no issue. Even if it's a third-party manufacturing, because these Apple phones are manufactured in I think in Tamil Nadu, right?
Yes.
And it is manufactured by some other company in India, right? So that is permissible. No issue there. So if they are selling an item, right, which is manufactured by some other Indian entity, and then it is like as good as trading of manufactured goods, it's okay.
Okay, so if
This must be the reason.
FDI,
This must be the reason.
FDI owned company manufacturing here can also do retail sale.
As I said, manufacturing includes third-party manufacturing also.
Okay, got it.
So which is permissible.
Thank
That
you.
is fine. No issue at all. Yes, sir. No, it may be so that since he is from, he must handle it. If it is single brand, you can open shops and then do it because he is single. Yes, you are right. It must be falling under single brand. Single brand you can import and then sell. There is no need for manufacturing because single stores is allowed as a retail. Yes, you are right. I think he's on dot. This is the reason. Clear? Thank you. Sometimes it doesn't come in mind. Once you prick, then you will understand. I said the single brand, 100%. Single brand.
Sir, I had one more question. So how does Zepto and Blinkit model work?
Yes. I have a slide on that. I'll show you that.
Okay.
Very interesting ones.
Yeah.
It will come after these 2 slides. Then I will have a detailed one when I talk about downstream indirect investment.
Sure. Because
So I will spend some time on that. Yes. So this is another way, and then there is another. You see, they have what they have imposed is another operating holding company where a foreign investor is having 49%. Then it has 19%. See, this is that indirect. This slide is for indirect foreign investment, wherein the foreign investor has less than 50%. So this company becomes what? Indian owned and controlled, not foreign owned and controlled. As we call, if some people are aware of this terminology, called FOCC or called IOCC. FOCC means foreign owned and controlled. IOCC means Indian owned and controlled. If it's Indian owned and controlled, then this company can have downstream investment without any problem. Right? It can indulge into any, this Blinkit is the same example, I'll come to that, right? Because what is Blinkit doing? Above this is a company called, Eternity is no name? Eternity. So this company had more than 50% foreign equity. So last year, they passed a shareholders resolution that my foreign investment will not exceed 49.5% diluted basis. It means taking into consideration ESOPs and other instruments which are issued, which are still not converted into equity. So they have passed a resolution of shareholders saying that our equity on a fully diluted basis will never go beyond 49.5%, which is 50%, less than 50%. So this company has become IOCC now. Blinkit is now into inventory, retail. That is permissible. Because a company with less than 50%, if it is IOCC, this company can have below it any company with any sector, even prohibited sector. You can be real estate, you can be retail, you can be tobacco, you can be those sectors which are prohibited in India, even the sectors which are under controlled in retail. So that is what they have done. Understood, right? So this is that structure basically, wherein if you see in the middle, there is operating holding services company. Foreign investors is 49%, 51% is Indian investors. It is called Indian owned and controlled, IOCC. So this company has a retail fund trading, which is Blinkit, right, gentlemen? So this is in between companies what we are talking about. And Blinkit is retail fund trading. Zepto is also coming with that. In public domain, there are two cases, which I will quote later. I'm not aware of, other companies, unless it comes in public domain, I understood, but Zepto is also, I think, introducing the same thing over a period of time. There are 4 or 5 companies, but public domain, there are 2 which I am aware. So I will come to that part, right? So this is what we were talking about. So what it effectively means, we'll discuss little later. And this is a retail inventory model, more or less same thing. Yeah, here it is. This is what we're talking about. So what they have done, Zomato now, which is eternal now. So they have passed a resolution. Last shareholders meeting, it says, company to cap total foreign ownership, including without limitation, primary or secondary markets, irrespective of whether it is FDI, FPI or indirect foreign investment, by and on behalf of first and national of India, including without limitation, foreign owned and controlled companies, the FOCC, investment vehicles, portfolio FPIs, NRIs, through except non-repatriation, Schedule 4 we said, which is foreign ownership in inverted comma altogether, and includes equities, shares or compulsory convertible preference shares, means convertible instruments, maximum 49.5%. So this become IOCC, IOCC can do it. The other example is this Brainweave Solution Limited. This company did a year before Zomato did. Zepto is also doing this. So what they said, subsidiaries such as Digital Age and Merihaki, this is of Brainweave, in the multi-brand product retail trading, which is subject to additional restrictions of foreign investments. Now they can do it because I am investing through an IOCC. Query is, this independent query, this I will discuss later. So, right, you understood? So this is what people are doing. So this I will discuss more in detail when I discuss indirect chapter on downstream investment, little more, but I think it is good that you raise the issue. I have discussed with an example here, so I think these people will understand in mind now. And very interesting and very knowledgeable. Then duty-free shops on international airports is 100% automatic. Pharmaceutical greenfield 100%, brownfield 100%. 74 automatic and balance under the government route and subject to certain conditions. And relevant infrastructure I have already said earlier that the following is allowed, balance are not allowed. Now this is financial services. What is financial services? This is asset reconstruction companies, ARCs, which is 100% automatic. Banking, private sector, 74%, 49 automatic, balance up to 70% government. Banking, public sector, 20% under government. Infrastructure companies, which is, we call it stock exchanges, NSE and BSE, which is 49% automatic. Commodity spot exchange, 49% automatic. Power exchange, CIC, and infrastructure also include NSDL and ISDL. Insurance company, now it is 100% last 2 months back. Earlier it was less. Now it is 100% now as per the new, I think, press note 1 of 2026. LIC is 20%. Intermediaries of insurance intermediaries like brokers, consultants, corporate agents, third-party administrators, surveyors is 100% automatic. And in addition to the FDI norms, they have to comply with insurance companies' foreign investment rules, notify Department of Financial Services and Insurance Regulatory Authority of India. So anything, everything, wherever you have a separate regulator, like in insurance, like banking, like NBFCs, so you have to also follow the rules and guidelines of that regulator in addition to the FDI norms as such. So that is without saying. Pension sector is 49%. Then this is an important slide. I think I spent some time on this. My purpose was to emphasize on this, not the other ones. Other financial services, what is this? Other financial services mean financial service activities regulated by a financial regulator. Who are those? Reserve Bank, SEBI, IRDA, Pension Fund, National Housing Bank, and other financial regulator or as been notified. No other is notified. These are 5 which are notified. Foreign investment in other financial services shall be subject to minimum capitalization as specified by the government. It means not an automatic route. Other financial services need to be regulated by one of the financial sector regulator. If it's not regulated, then it is not automatic route. Take a case. I am not registered NBFC, but I am carrying out NBFC activity because NBFC says dual condition must be satisfied, 50-50%. 50% of asset side must be NBFC and 50% of income must be, gross income must be, otherwise I am not NBFC, I don't need to register. CIC also need not be registered unless I am borrowing public funds and 100 crores and 500 crores. So if I am not covered by NBFC definition, CIC definition, it means I am carrying out your activity but I am not registered with NBFC regulator. If I am not registered, I can't carry those activities. That is the fundamental if you have FDI. A normal company can do, right? Tata Sons is doing, and Adani holding company is doing, Adani Enterprise, Reliance of course doesn't have holding company, it is doing through LLPs. Then you have Birla companies, all these companies are holding companies. So holding companies, what they do, they make it sure that their criteria of 50-50 is not met. So that they keep it in a way that the income side always is more 50% by way of some trading, by some other income, and then they treat not net income but the gross receipts. So they keep themselves out of, but they are doing all the activities which are financial service activities. If they receive FDI, they can't do even a single rupee investment downstream. Unless they comply with downstream investment, they can't do financial service activity. It means either you comply with DI norms, downstream investment, Regulation 23, file form with DI, etc. Otherwise you can't do it. So any company with FDI, if that company is indulging into any financial services, giving loans, giving guarantees, investing in shares, investing companies, that is prohibited, 100% prohibited, not even 1 rupee is allowed. That I will show in a different slide that what is allowed, what is not allowed, but today it is not allowed. If it is not allowed, then you have to take approval from Government of India. But see the last line. Downstream investments by any of these engaged in services is treated as indirect investment subject to downstream investment to DI. Then what it says, read the second last paragraph. Minimum capitalization requirement is $20 million for a fund-based company, because these are fund-based. Giving guarantee, giving loan, investment is a fund-based. $20 million. How much is $20 million, sir? 180 crore, 200 crores approximately. So nobody will bring in 200 crore from outside, irrespective of the percentage. This 200 crore, 20 million is irrespective of the percentage. It may be 5%, it may be 100% also. Yes, sir. I am not? Registered new. I am not registered with any regulator. Yes. Yes.
Now, can I do LLP the same concept because LLP, NBFC rules?
No, LLP you can do it under DI, na? Because if you that you can do under LLP.
I can do FDI in the financial service, other financial service sector, do it from LLP. So LLP is here, and I'm not fulfilling 50% criteria. So I'm not required to take a registration.
You see, LLP is not a company. It's not NBFC, so that is out. In any case, LLP can never be NBFC registered. LLP cannot do financial service activities. So you have to go to RBI Act. So there it is defined that any other entity other than company, LLP, trust, individual, partnership firm, whatever, they can do financial services like investing in shares, listed company shares, etc., only from own funds or from the funds which are specified relatives and those like partners in a partnership firm. LLP partners can only give and relatives can give, nobody else. If you borrow from, or you can borrow from banks and institutions, not from NBFCs. If you borrow from third party, you take ICDs, you borrow from NBFCs, it is not permissible. Even for LLP, other than company, no other person, individual, LLP, trust, partnership firm. These are for politically, right? Entity will cover. They cannot borrow and then invest in any shares, give loan or give guarantees. As simple as that.
They can do from own capital.
Hanji?
They can do from
Own capital is no problem. Own capital auto borrowing is also not permitted. It should be own capital like partners. Individual, they have said relatives. Partner, they have said partners and their relatives. Nobody else. Like in case of private trust, since I'm dealing with private trust, the answer is private trust through the trustees or beneficiaries, only beneficiaries, not even trustees, and their relatives. Not even trustees if they are not beneficiaries. So LLP is not permitted. So here it is 20. Same thing. This is reproduced from the FDI policy itself. You read master directions and NID rules. RBI Act, RBI Act, section 45IA and 45IA of RBI Act, which is a separate chapter in RBI Act. RBI Act में chapter है, जिसके basis, on that basis they have made NBFC regulations. It is not FEMA. It is RBI Act. Under that there is a chapter. I don't know which chapter, but it is 45IA. So this is important. So I covered this, and then convertible notes by Indian startups. So startups have recently been redefined in February 26. So startup they have defined now as a private limited company. Earlier it was only private company. Now it is a registered partnership firm, limited liability company, and multi-state cooperative society, and the cooperative society registered under the state law, which within a period of 10 years from the date of incorporation and registration has a turnover of not more than 200 crores and involved in innovation, development, etc., etc. And it must be registered with the DPIIT. Only then you are a startup, otherwise you are not a startup, which is for the purpose of FDI, for the purpose of other exemptions and regulations. And they have introduced another concept of deep tech startup. This is a new terminology used, which is a startup, but with additional benefit. So here, so 10 years, it is 20 years, 200 crores, it is not 300 crores. Condition, both the cases, it should not be found out of split up, reconstruction, or business. Like we have ATIA, etc. Because it should be new entity, new infrastructure, everything new, not the same. And then there is a difference between startup and deep. Deep has to be involved in a little higher category of innovations and R&D center. I'm not reading this. I think you can read it later. And then conditions are that you can use the funds for their activity, but not for the following, which is residential, loans, advances, capital control, other entities, investment, shares, securities, vehicles, motor vehicles, jewelry, etc., unless it is necessary for the purpose of business of the startup itself, not as a purpose of investment or as a unrelated part. Otherwise you can have motor vehicle for the purpose of companies, executive, senior executive, not for the purpose of having it as a promoter car as such. Then issue of now this is that was definition of under DPIIT that is borrowed in FDI rules. Once you are covered by the definition, then what are the regulations which are relaxed for the purpose of startup? As I said earlier, FDI can come only in equity instruments, which is pure equity capital or convertible debentures preference shares, warrants, and ESOPs, nothing else. But here they have given a dispensation which they call convertible notes. It means these are convertible notes later at the option of either party, but starting is a loan. It's a loan, but not an equity instrument. So for certain number of years, you keep it as a loan. You can also return with interest, and you want to convert it in with interest later on after 5-10 years. You can do it. You can do it after 1 year also. You can convert it with interest also. Interest is not necessary to be paid. It can also be form part of the conversion. So there it says, when you issue, there are no regulations on that, because that is not defined under the FDI. I've given one example of how people are doing it in the next slide here. I will discuss with you later about that, right? And what more important is, where is that? Yeah, here it is. Example. Let me read the example. Sample terms of one of the startup that instrument is: the principal amount and accrued interest under the note shall automatically be converted into a class of equity shares substantially identical to that issued in the qualified financial and same rights as for other CN holders, but at a price per share equivalent to the lower of some 80%. I have not understood exactly why I have not handled it, but this is how they structure it. They structure it in such a way that you receive money, it's a debt, anytime it can be repaid, but at the same time you get a benefit that you can convert it later, which is not otherwise permissible. There are few conditions. What are those? One is under Companies Act. If I come, Companies Act, the deposit regulation, because anything I get debt from anybody, it is a deposit. Deposit means I have to follow conditions of Section 73. I can't follow because these are different categories. So they have exempted it. What it says, any amount more than 25 lakh or more received from a startup by one person in a single tranche from a person in a startup company, convertible loan, it is not a deposit. So you get exempted from Companies Act deposit regulation. Then what is this instrument? When I issue, it is an instrument which is not equity. It is not Section 62. Neither private placement, nor ESOP, nor right issue. So you follow special resolution at that point in time. It is like a borrowing, and then you comply with the Section 176, 179. Then file MGT 14, etc. So that is Companies Act. And then there are filings. You file a separate form when you issue CN. When you convert it, at that time you file FCGPR, which is for equity instrument, and some documents are to be attached. So that is listed here. So this has been abstracted from forms portal and reporting, master directional reporting. It means these things you won't find in rules and regulations or in FAQ, you find it there. Anything compliant, you have to follow back on forms portal and also on master directional reporting. So this I have discussed, and then one tranche can be not less than 25 lakh, right? And then the pricing guidelines will apply. Even NRI and OCIs can also invest on a non-repatriation basis under Schedule 5. Under Schedule 4, if it is repatriable, then it comes under FDI regulation. Even acquisition or transfer also of CN will be regulated like a FDI instrument. Same thing applies. And what it says, convertible notes may either be converted equity shares or repaid within 10 years from date of issue at the option of the holder. Repayment or sale proceeds may be as per the guidelines. And then startup through merger, etc. is not permissible. Merger they have allowed only 2 or more startup companies or 1 or more startup companies with any small company. Otherwise, you can't merge with a company which is not a startup, then you lose all the benefit of a startup as such. Because when it is merged or demerged, then the same terms and conditions of CN will apply to the merged entity, so that you will lose as soon as you don't comply with this. And then the startup, I have given some other, this is via DIPPIT FAQ. This is not in the part of FDI policy or this thing. This is part of the DPIIT circular, that certain things are not covered, that you can't do certain things, you can't have permutation combinations. So I'm not reading this. I think somebody can read it and you'll understand. This is as simple as that. Now this is important part, FEMA valuation. So this one page covers my 90% of what I will be discussing in the subsequent slides. So let us start from left hand side. Slides will be made available to you, madam, don't worry. Today itself. Or maybe you give it to me, I'll give you that. As I said, don't mind it. Concentrate on what I'm saying, right? Because you never know which sentence I will say, and you'll get practical knowledge, because my purpose of coming here is only to give you knowledge, not to tell you which page to read. Sorry. So left-hand side is listed company. Listed company, they are very simple. Follow SEBI guidelines. Whether it is ICAI guideline, whether it's the preferential allotment guideline, whatever guidelines you go by SEBI, even for delisting guidelines, whatever is the pricing determined as per SEBI, you do it. I have no problem under FEMA. Right or wrong, I am not concerned. Right issue, if they say, SEBI say you can do it at a less than fair value, at par value, you do it. If it is all same, I have no problem, right? So SEBI is confirmed. Only thing is, it should be certified by a SEBI registered merchant banker or chartered accountant, only CA, but that's all. And that too as per formula of SEBI, not your own formula, simple. It's an unlisted company, then it has to be internationally accepted pricing methodology at arm's length. Very difficult terms to understand. Arm's length we understand because we deal with section 188 Companies Act and we deal with transfer pricing, right? This is arm's length. What is internationally accepted pricing methodology? This is not prescribed anywhere. In FEMA, it is not prescribed. If you people recall 56(2)(7)(b, issue of shares, they had prescribed 3 years back a lot of formulas in case of startup, all those things which have been withdrawn 2 years back, now they are all has gone. So they have given some fancy formulas there other than discounted cash flow. 56(2)(10)(11), you have this book value method, book value substituted by 3 immobile property shares and jewelry, etc. Otherwise, it is book value, simple as that. So they are given some fancy formulas, and that also gone. So what is that? That I will discuss in the next slide. What I understand international currency, which I understand, which you may also like to refer at some point of time. Then next slide is PROI, NRI, subscribers to memorandum can be face value. This is very, very interesting aspect for practical aspect. Today, is there any minimum authorized capital required at the time of, minimum authorized capital or paid up capital or subscribed capital required at the time of incorporation? Answer is no. I can have only 7 rupee, 7 shareholder public company, 2 rupees for private company. Earlier it was 1 lakh and 5 lakh, that is gone now. I can have, and authorized separate, then there is a subscribers. I subscribe to take so many number of shares. Authorized, you forget about it, so go by subscribers clause. Can I put 100 crores and subscribe at par value? And I know that after a few months, I am acquiring some big business, and my valuation from 10 rupees will become 1,000 crores, 1,000 rupees. Can I do it? Answer is yes. It means if I incorporate a company in India and a foreign resident becomes a subscriber, it is applicable even for a 100% subsidiary also, right? I acquire 100%, one is my nominee, only one share. I can put 100 crores as a subscribed capital. I bring in subscribed capital, 100 crores I bring in as soon as my bank account is opened, subject to conditions. So it can be a par. After a month or two, I allot shares to somebody else, I make it a joint venture, or I want to bring in more funds from abroad. That time I have to do at per fair value. Fair value is international accepted formula. If it is a company which is going to manufacturing or business activity, I have to do it on a future profit based on DCF. And DCF in all probability will never be less than par value. If I decide my DCF is below par value, it's better to close the unit. Why should I have a cash flow which is negative? Isn't it? It has to be plus only 10 rupees, 1 paisa, or maybe 11 rupees, 12 rupees. It may have to bring in at that price. So what people do to make sure that there are no issues on pricing tomorrow, they will minimum whatever they have to bring, they will become subscribers. So this is one aspect which is a practical issue, which is I have done it. RBI has confirmed that subscribers, how much is not indicated. It can be 100 crore also, 500 crore also. So that is one part. Come to right hand side. This was fresh issue. Now come to right hand side. This is a transfer from resident to non-resident or non-resident to resident. Here formula is very simple. If I have to give share to a non-resident, it must be not less than fair value. If I have to give, if I have to sell, he has to sell at a fair value or lower, right? But this is a simple arithmetic. So this is what it says: transfer from resident India to foreign, price shall not be less than the fair value, as per the valuation. Right hand side is same thing, which is with the reverse now. Convertible investment, as I discussed in the beginning, all convertible instruments have to be valued fair value as of today. Whether it is swap, whether preference shares, whether warrants, or whether debentures, even partly paid up shares. Partly paid up share, I said here you have 12 months under FDI, otherwise company there is no limit. So up to 1 year, it means up to 1 year your valuation is fixed, right? Why these promoters, big IPO, they issue warrants? Because they want to fix their price today. If they know that after 18 months, price may go up, no, not go up, I don't know. So all promoters, when they want to enter, they enter through warrants. Because they know after 1.5 years, our price will either go up or whatever. Unlikely situation where the price may come down is a different matter. I'm just keeping a track of Zio Financial. So it issued at 305 rupees last year, warrants to promoters. And now it is, I think, at 240 or 2 something. It is already down by 70, 80 rupees. So this is an exception. Otherwise, generally, I find people generally make money promoter, they don't. So this is very important aspect that when you can do a timing either way. If you are strong Indian company, then you can put the foreign party into defensive situation that look, let us decide today, tomorrow's appreciation is company in mine, not yours. And if the foreigner is strong, then he will put it in a different way. So point is, you upfront, you fix the price for convertible instrument. This is the philosophy behind this. Then NRIs and PIOs on a non-repetition basis, like Schedule 4 NRI, so their valuation pricing doesn't apply in that schedule. It means if you enter in a company under Schedule 4 over NRI OCI, you are not to apply FEMA pricing norm, but you have to apply FEMA pricing norm. If it is Companies Act, if it is a private placement, then you have to apply that registered value you need. If a right issue, then there is no valuation required. So it is Companies Act, not FEMA. Pricing between two non-residents, FEMA is not applicable. It means you can transfer at whatever price. Of course, if it is a related enterprise, Indian company also, then you have to follow the transfer pricing regulation. Otherwise, you will get stuck under income tax, if not under FEMA, but generally yes. And your question of FOCC for this purpose is also treated as a non-resident. If FOCC transferred to a non-resident, suppose it is without valuation as per FEMA. Any other regulation will apply, that is a different matter. Then SEZ, capital imports, that is a specific, not discussed. Then it's a transfer of equity shares of Indian company by Rashtra India under SEBI regulation, I have discussed already. Then what is transfer? Let me complete this sentence. Transfer includes, sometimes people say transfer is generally actual transfer. You read the definition of transfer under RBI Act. RBI Act, not FEMA. RBI Act defines transfer, which is different from transfer which you and me understand under Income Tax Act. Here transfer includes gift, transfer includes mortgage, transfer includes charge, transfer includes pledge also, lot of things. I have not abstracted here, next time I think I'll put that also, it's really important to understand. So here they say, when I say transfer for the purpose of pricing guidelines and for the purpose of compliance with FEMA, it will include liquidation, merger, demerger, amalgamations, incorporate district, etc., buyback and capital reduction also. It means these 5 categories are also part of transfer regulation as far as FEMA is concerned. Sir?
Tell us, okay, now you 150 is the price, the arm's length price or the market value, and you are converting at 100 rupees. That is one issue. Second is, what if I do a conversion later, so fixed price today, issue at the time. I've just mentioned the mechanism of the valuation, which is allowed
yes, formula
at the time of the formula, and today that value is 100, for example, and doing that formula. In future, that price will come 150 when I'm converting it. So in both the scenario, can the authority come and tell me that there is a difference in the price of at the time of the issue and the conversion, and now you're converting at a higher price? or in first example as a lower price?
See, in case of warrant and partly paid up shares, it is already fixed. Upfront it is fixed because they no formula, nothing happens. It is only period they give you. ESOP also is formula based because SEBI regulation, you can issue at par also, right? And you can issue at a price which is prevailing at the time of when these rights are granted to you, and then after 3 years you see the difference is treated as a sale and procurement value, and then you pay only that much of money which is agreed at there. So they are already defined under FDI. But for these conversions, if the price is higher and you are issuing a lower number of shares, that is permissible. They will say yes. They will say please do it that way only. You can't do it. They say that if the price has gone up, you can issue less number of shares. If the valuation come down, you can't issue more number of shares. So that is possible, because you have to file valuation report at the time of conversion also, na? At the time of conversion, you have to file the valuation report. If the valuation report is either way plus minus, plus hai, so there is no issue because I will issue less number of shares. If it is less, then I can't issue more number of shares, which I agreed at the time of issue of those instruments. Is clear, right?
But the conversions are the ratio will depend on the price. So in the agreement, when I'm mentioning, for example, that this number of equity means preference shares, CCPS or CCDs would be converted into equity share after a year, do I have to mention the ratio also at that time? 1:2?
Yes. Okay. See, that I have covered in one of the slides separately, that under Companies Act, for convertible instruments, there is option. Either decide the conversion at the time of issue or at the time of conversion, within 30 days before that conversion. Under FEMA, you have to define the percentage conversion at the time of issue itself.
Okay.
You can't postpone it. Because otherwise, how will you calculate diluted share capital? You can't calculate. Because if you keep it open-ended, then you can't calculate. But only in case of formula-based, if you are saying, there you keep in mind maximum how many shares can be issued. The maximum is already fixed. Even if in case of a future, you see some margin you take, so there you at the time of issue itself you say maximum इतना दूंगा, इससे ज़्यादा नहीं दूंगा number share आपको.
Okay, that has to be mentioned in the
उससे कम दूंगा आपको, उससे कम दूंगा. लेकिन Companies Act के अंदर there is a possibility, because there is a law, it says that conversion formula can be at the upfront or can be later also.
Yes.
But FEMA overrides that, so automatically if you are issuing to a non-resident, FEMA prevails over Companies Act.
Okay. Thank you, sir.
Right. So this is a slide which is basically an elaborated version of the previous slide. So this says the same thing. I am not repeating it. And deposit regulation I have already discussed. This is what I was talking. This slide that under Rule 2C9 of deposit regulation, secured debentures are not deposits, and then the company share capital rules. In case of convertible security, they say either you do it upfront or do it at the time of conversion, 30 days before that, but FEMA overrides this Companies Act. And pricing guidelines I have already discussed with you, transfer from resident to non-resident, so this I am not repeating here. And this is also I have discussed in that slide itself. And non-repeatable not allowed. Convertible instrument, the same thing which I have discussed in the last slide. This is important. How and which valuation report is acceptable and valid, and within what period? Earlier there was some confusion, some disparity. Last year they have incorporated this, not in rules and regulations. They have incorporated it as part of firm's manual. So this is abstracted from there. What it says, on the date of transaction, what is the date of transaction? Fresh issue, date of allotment. For transfer, it is date of you sign the SH4, if physical share, or you give delivery instructions signed by you as transfer of shares. It may take few days before it is actually transferred in your account, demat account, but it's so for demat account, the day you give instruction, that is the date of transfer. For fresh issue, it is the date of allotment, SH4. So uske prior, how many days valuation report you should be? Some people are saying 1 year, 2 years. Oh, there were various permutation combination. Now they say, what is important? Important is not the date of issue of report, on the date when I'm signing the report. is the date of valuation date which I mentioned in the body of my report, that I am taking the projections and the information, everything, either a cutoff date, which may be 31st of May. So 31st May is my date on which I am drawing valuation based on financial everything. I may issue the report in June, July, August, September, May after 5 years. You never know. Sometimes people forget about taking valuation reports. It so happens. There may be, I will come to that, which are those instances where people get stuck. But after 5 years, RBI says you file a valuation report. I can't go back beyond 60 days to generate UDIN. I have to do it as of today. I can't do it 5 years back. So I will issue the report today, but valuation date is 5 years back. 5 years back should be a date which should be within 90 days from the date of transaction, right? It is not important that I must have the valuation from the date of transaction itself or before. It is not also important. There have been cases in the Income Tax Act also, 56(2) and 56(10) also, that when I transfer shares, when I issue shares, is it necessary that I must have valuation report or audited balance sheet, because it is based on audited balance sheet on the date of transaction or later? Courts have given a judgment that if the valuation date is prior to same date or that date, because in case of transfer of share, valuation date is the date of transfer, right? In case of fresh issue, it used to earlier, now it is withdrawn that you can use the last year's audited accounts till the next AGM, all those things. So they say even if valuation report is signed later, but it pertains to a date which is relevant for the purpose of that transaction, so it is treated as valid. So I am issuing today, 5 years later, I am issuing a report with today's UDIN. But the valuation date is mentioned there that I am taking financials or projections as of a cutoff date. So that date should be 90 days, not the date of signing. This example says what? Issuance is 31st March. Date of signing or report is 1st February, right? Which is within 90 days, that is fine. But valuation date, it has mentioned 15 December 23, which is beyond 90 days, so this is not acceptable. So it means signing of report is important but not material. It can be even post-transaction also, but ideally should be before the date of same or different. Otherwise, 90 days is valuation date, because now as per the valuation standards, which is applicable to all chartered accountants as per the ICAI standards, you have to, in the body of the report, you have to mention what is the valuation date, in respect to the date. So that is important. So I am emphasizing again and again on this so that it is understood that what exactly it means. Then now, what is internationally accepted methodology? Some people say, I don't have working, I don't have any business, then how do I value my company? Some people say, I don't know the future. Especially if suppose I have to value a company today, I am an outsider. I'm not a major shareholder. No promoter will give me projection, because this is also sensitive information for SEBI. Because if I put in the public domain what a projection, so then my share price will go up. Give an example of NSC. National Stock Exchange of India. I think these shares are moving for the last 3 years. A lot of people have made 10 times money, 20 times money. When I'm transferring this unlisted company, I don't have valuation. How do I do 56(2)(10) income tax? कैसे करूँगा मैं? मेरे पास है ही नहीं. Problem है ना? Company में देगी नहीं. Company will not give me financial for future year, not for the past year. I can't even make out 11 evaluation. Because they have shares also in 10 subsidiary company, they have immovable property also Bombay here and there. How do I value? So we got stuck. Then what to do? I said that let us assume. Let us assume take the book value of the last audited accounts, which is available. Say 100 rupees. Say 100. I am selling at 1,000 rupees transaction happening, because nothing has happened before 1,000 rupees in the last 3-4 years. I am monitoring it for a client. I am aware of this. I said at the worst scenario, most aggressive view, how many times the valuation of immovable property would have gone up in the last 10-15 years of the existence we had? 10 times, 20 times. What can be the value of their downstream investment companies? 10 times more than what is book value. Add that. Then also will come 150 to 200. I said 1,000 rupees is good enough. Based on that, you take a report with a disclaimer. I have done on this basis. Income tax officer क्या करेगा? Next year he will say balance sheet lao. I am valuing as on today. I am relying on balance sheet of March 25. 26 available नहीं है. जब आएगी तो मैं दे दूंगा उसको. In any case, it will never be closer to that valuation. It will always be much higher. और मैंने उसके बाद अब ट्रांसफर करना है. और ट्रांसफर करना है, मेरे पास वैल्यूएशन नहीं है. अब कहाँ से मैं तो मार्केट प्राइस देखता हूँ क्या 1200-2100 चल रहा है, फिर बोनस आ गया उनका बहुत सारा, फिर कैलकुलेट ऊपर नीचे हो गया. तो क्या हो रहा है कि सम टाइम पीपल डोंट गेट DCF that are not available, and I have seen listed companies where their merger and demergers happen. So they also send notices to shareholder. It is available in public domain also. They have valuation reports, and they say we have not considered DCF because we don't have information on from the company. Even if my own company, because company is not interested to share the future projection because of sensitive information from stock exchange point of view. So I am doing it based on some other methodology, listed company, you see parallel and some other industry criteria. So I have abstracted it from a book. This is, I've given the name of the book by the top. This is 2018 edition, latest one. After that has come, I am not aware. So it has listed out in 2 slides. Yeah. Which methodology is good for under what circumstances? I think interesting to read for 2 minutes, right? DCF is good where? Where is a publicly traded and private with identifiable cash flows, facilitates cash flow forecasts, long-term time horizon, confidence in forecasting the firm's cash flows, positive in future, firm's competitive advantage, the magnitude and timing cash flow is very significantly. So this cash flow is fine. And generally in case of any operating company, you follow DCF. Unless it's a force majeure, like I gave the example of NSE, it's a force majeure for me. And listed company is force majeure because I don't want to put in public domain what is mine. Because now, what SEBI says, not only the final valuation exchange ratio, you also give in the annexure how you have computed. And if it is a private placement, preferential allotment, section 62(1)(c), then when you file from PAS 3 with ROC, you have to mandatorily enclose valuation report. I have seen PAS 3 of many companies talking about this Flipkart and Amazon, all those things, as to what they have done. I found that they have only enclosed two pages of valuation report from EY, not even full report. They say we have complied with the law, enclose some 2 pages, that's all. Because if they enclose everything, you will know how they are valuing these startups and these companies which have no cash flows, isn't it? So this is one. Then there are comparable companies, if they are available in the market, in the public domain, which is similar growth, returns, short-term time horizon, earnings and cash flows are positive, sufficient information to predict cash flow. And firms are cyclical. For P ratio, you can use. Comparable transactions. Is it comparable companies and comparable transactions? Then recent transactions in the public domain, same or comparable industry. Then you have replacement cost, where the cash flows are negative and not available, you are not good happy. And where the tangible book value is good enough, like in case of a holding company, investment in shares, wherein not have much of operations in terms of income. So you do it on asset side basis. Then you have breakup value in case company is not a going concern. Liquidation value if the company is under liquidation possible. The real options like patents and IPRs and all those things. So this is an indicative which gives you an idea. But end of the day for most of us here, either it is DCF or it's a book value. And for a company with operation, you have DCF. In case you have surplus asset on the balance sheet side, which are not used for operations and business operation, then you do it as a market value. In immobile property, you use a circle rate. If it is investment in share security, that has to be separately taken care. In case of a lot of downstream investment company, then it is a consolidation, all added together and then goes up. Like on the balance sheet side, I have out of 100 balance sheets, say 25 crore is my investment in 10 companies. I value for 75. Discount flow, and 25 I substitute by the valuation of all those 10 company downstream and then make it together. That's valuation of my main company. Yes, bhai. नहीं उससे फर्क नहीं पड़ता वो तो these are only indicatives. So there are n number of things, n number of formulas. So anything you can twist here and there and do it, and these are not accepted formulas. They are basically indicative formulas wherein you can tweak it based on your facts and circumstances and the valuation requirements also. And these are special cases. I think I have discussed that you cannot issue fresh shares below par value. So it has to be at a book value only irrespective of the value. Investment holding company says sum of total parts. NSE I have given you example. And buyback, capital reduction, I said not applicable. So this is, I think you must have heard Tata's case that when Domoco wanted to exit at a assured return, then they wanted assured return. So then they RBI said it is not permissible because you can't exit at a price higher than the fair value. So they then got a international arbitration award for London. They went to court, and then High Court decided that yes, it is possible, you can do it. What I want to draw your attention is this. This is a slide. This is the latest I have quoted from 26th August 25 Supreme Court judgment, and which says compensatory damages under international arbitral award, not consideration for transfer of shares, but a permitted capital account transaction, share is surrendered subsequently post damages. It means what I am paying is not share consideration for sale. It is a compensation of my have entered into an agreement with the party, two parties, wherein I have breached that agreement or arrangement. So I have gone for arbitration. Arbitration decided that I give the foreigner X amount, irrespective of anything else. Even if it is violation of FEMA valuation guidelines, I am okay with this. So what I have abstracted, important part is this. There are 7-8 cases which are already there in High Court, Supreme Court. I am quoting from RBI affidavit. RBI's affidavit, I think running into 3-4 pages, is abstracted in this judgment of 20th August. Exact wording I am reading out to you. This is important for understanding. In view of the above, it is submitted, this is RBI, that the payment of compensatory damages as awarded by the learned tribunal, being in the nature of current account transaction, is enabled under Section 5 of FEMA current account rules by resident respondent to non-resident. Petitioner so-and-so per se would not require an approval or permission from the answering means RBI under FEMA. Further, it may be noted that payment of some compensatory damages without transfer equity share does not fall under the purview of RBI. The submission made here and here above are without prejudice to the position, etc., etc. So this is basically, and RBI has maintained consistently a view that any compensatory damages or payment under arbitration is a current account transaction, irrespective if related to transfer of shares or not. Now, ESOP, more or less, I think this is also specific to an employee or a director. So you have to read it very carefully what it covers. If it doesn't cover, it is not covered. It says equity instruments to employees, directors of holding company, joint venture, wholly owned subsidiary, India and abroad. Only these people are eligible. Consultants are not eligible. Directors, of course, are eligible. Independent directors are not eligible. Then the company, etc., within the sectoral cap, even sweat equity is also covered there. What you have to do when you grant these rights, at the time of grant also, you have to file form ESOP with the AD Bank on the forms portal, only for the non-resident prospective shareholders, right? Who are your employees or your director who are non-residents. Once they exercise their right and get the shares, that time you have to file FCGPR. FCGPR has to be linked with the ESOP filing form. Valuation is as per SEBI guidelines. That time you are not to take internationally accepted formula, whatever is acceptable, that RBI accepts. So that way it is done. So it means it's a 2-level reporting, ESOP, and then you have to file FCGPR. Then there are, you see, there is a mechanism for when you issue ESOP. One is issue ESOP cashless. Other ESOP is that you issue at a price which is lower than the market price. Third is sometimes you issue ESOP to employees through a trust which is established by a company itself. So if you pick out any listed company's notice of shareholders, it comes regularly in our company. So you will already find there are 3 resolutions separately for ESOPs. Last resolution will be to grant loans also. And another will be that it will be part of the trust. Through trust we will route it. So there are three broad aspects: cashless, below fair market value, and through the trust. So in this forms manual, they have given separate dispensation. How will you do it? If suppose shares are given to the trust by the company at the time of vesting, but when you exercise, you are exercising through the trust, but you are getting in the individual name. Then how do you do it? So they have given the whole procedure under this category in that form manual. It is not part of rules and regulations. So this is important to understand. And important part here is second paragraph. An individual who is a person resident outside India exercise option which were issued to him when he was a person resident in India shall hold shares acquired on acquisition on a non-repatriation basis. This is a practical situation. I am employee of a company in India today. I have got ESOP entitlements. After 2 years, by the time I got this vesting in me, I become a non-resident. So I have to apply, I have to send money to get these shares. Even if I am sending money from abroad and from my NRI account, it is still non-repatriated because the shares, ESOPs were given to me when I was resident. So this is part of rules itself in the master direction itself. It means it will be non-repatriable. It will be allotted to you. Payment you can make either from abroad, from rupee account India, whatever. Otherwise, if you have to get shares which are repatriable rights, then you have to necessarily send money from abroad or out of your NRI account, right? If it will be repatriable. If non-repatriable, then it can be from NRI account also, because NRI can't maintain a normal rupee account like you and me maintain. If an NRI, while he is claiming to be a status of NRI, maintains a rupee account, that is contravention. Because when you end of the tenure, you want to remit money under USD 1 million scheme or under current income scheme, the money has to go out of NRO account. It cannot go from your rupee account. You have to first convert into NRO, then only you can use the facility as NRI. This is also just, I'm telling you this. So this is important because I handle this for one company. So this is how it happened. He was resident, non-resident. So this is how he got stuck, but not stuck in the real sense, because as Jay was asking me, that even in the case of real estate, if I buy in my personal name and I become a non-resident, all those things, so under what category can I remit funds abroad? If I am come under FDI, Schedule 1, then it is unlimited. It is not important, no ceiling applies to you. But if I am an individual NRI OCI and I am covered by non-repatriation Schedule 4 or otherwise I have invested in my personal name through stock exchanges, then I am governed by either USD 1 million route or current income route. USD 1 million scheme comes under remittance of asset regulation, and current income comes under deposit regulation under the NRI debits in NRO account, which is current income can be repatriated unlimited if it is on account of interest, dividend, pension, salary and any other current income. Profit in a partnership firm post-tax is a current income. Profit in a LLP credited to my account is also current income. Only condition being that you should not use partnership and LLP as a conduit to do some transactions, like you buy real estate in LLP, right? And you then sell it. You bring it as a profit to the partner, then you say it is a current income. So that is not allowed to be repatriated as part of USD 1 million, because RB has issued 3 years back. It came in news also that it is not possible. So coming back to ESOP, you have to do it at two ESOP, then FCGPR. Money can come from abroad. If you want to invest through your NR account, then it becomes non-repatriable, otherwise it is permissible. Now the next chapter is transfer of equity instruments. So this is a table which I will discuss. Then connected to this, there are 6 slides, right? Yeah. These 6 slides are elaborate, which are abstract from the rules and regulation, but these are put into this table. Like, let me read one for understanding, then I will revert back to the table. A person resident outside India or a person in India may transfer equity instruments. A person resident outside India not being NRI and OCI, because there is a separate dispensation for NRIs and OCIs. Other than NRI OCIs is a different dispensation. Because here, when I say person resident outside India, it is not individual. It is any person resident outside India. Anybody who is holding shares in an Indian entity, which is a company or as well ECB, by way of sale or gift, the equity of Indian company or units as held by any person resident in India, includes transfer of equity, either replace हो गया, where equity is held by a person resident in India on a non-repatriation basis by way of sale and transfer to equity on a repatriation basis, then it has to go. See, fundamental principle is NRIs and OCIs can only hold shares on a non-repatriation basis. Non-repatriation shares can be held only by individuals, NRI, OCI under Schedule 4. No other entity can hold foreign entity shares on a non-repatriation basis, as simple as that, right? So now this non-repatriable right shares can change hands. Today I am a resident, tomorrow I may become a non-resident with a non-repatriable rights. Then I want to transfer that share. It may be a non-resident Indian on a non-repatriation, or it can be on a repatriation basis. I can transfer it to another, as a non-resident to an Indian resident, or I am Indian resident, I want to transfer it to a foreign person resident. So all these combinations are there. And then it talks about listed company shares. You can sell on stock exchange. Unlisted, of course, you can't sell on exchange. So what I have done, I made this slide. I think let us consider this slide. Otherwise, there will be a lot of discussion on the other part. The first slide says, first row says, heading is transfer seller. Who is a seller? Who is a buyer? And what is the mode of transfer? If I'm person resident outside India other than NRI, buyer is person resident outside India, means NR to NR, right? It can be by a sale or gift, which is permissible. Gift from outside is NR to NR is permissible. Then person resident outside India, optionality clause, person in India, by way of sale, this is also allowed, subject to no assured return. Person resident outside India to person resident in India, it can be by way of sale, gift, or sale on stock exchange. It means a person resident outside India is seller and Indian is a buyer. Foreign to Indian, it is allowed on 3 modes: sale, gift, and sale on stock exchange. Person in India to outside India is allowed by way of only sale, not by way of gift, because person resident outside India cannot buy on a stock exchange. Person resident outside India cannot buy on a stock exchange. Under FDI policy, it can buy under Schedule 3, when we come to that later, which is NRI and OCI on repatriation basis investing in the listed companies through a dedicated bank account under a PIS scheme. That is a separate scheme, because there the seller is not known, right? Because seller can be anybody on a stock exchange. But here, if it is a unlisted, it is off the market transaction or an unlisted company transaction, then Indian can sell to outside only by way of sale. If it is a gift, if it is a gift of shares, both repatriable and non-repatriable, there is a condition. You cannot gift to a person resident outside India without taking RBI approval in advance. It's a prior approval, and the limit, there is a limit also, which is 5% of paid up share capital or USD 50K per financial year. It means even 1 rupee, if I have to gift as a resident to non-resident, it has to be via RBI approval, prior permission. It is not automatic, that too only to a relative, not anybody else. It means person resident in India cannot give by way of gift to a person resident who is not my relative. Then NRI and OCI, holding shares on repatriation basis, means Schedule 1. It can sell or gift to a person resident outside India, no issue. NRI, OCI on a non-repatriation basis, which is Schedule 4, means when I was a resident, I acquired the shares. Now I want to sell it to a resident person outside India on a repatriation basis. It is sale with pricing guidelines. NRI, non-repatriation, India, non-repatriation, it is no pricing guidelines. Person resident outside India, including NRI, on a non-repatriation basis to outside person, it's a gift. Gift is same thing. It has to be prior permission of RBI, that too not exceeding either 5% capital or USD 50,000 US dollar in one financial year per gift, not aggregate gift. NRI is non-repatriation, NRI non-repatriation gift oriented. It means an NRI holding shares in India wants to give it to another person a person who is an NRI on a non-depreciation, that is allowed by way of a gift also. Person resident in India and outside India, to either way on deferred consideration. This is the important part. So now what it says, between two parties, resident and non-resident, generally the sale consideration must happen simultaneously before the transfer is affected, right? Before you sign HS4 or before you sign delivery instruction, 100% payment must have been received. But there is a catch here. They have given you a dispensation. So 25% can be given upfront and balance can be paid in 18 months. Here, as the gentleman was saying, this is not conversion, so valuation is fixed as of today. So you pay 25% now and balance in 18 months time. So generally, in what circumstances this happens? Sometimes what happens that I have value a company today, I want to acquire that company, and valuation is coming, say, $100, small amount, just for sake of discussion. But there are certain variables which I am not aware of today, like receivables, payables, any contingent liability, and I say that since you are a promoter running this company, you continue for another 1 to 2 years, I will give you some more money, you become my employee, but I will settle your, you see, the consideration amount in future, and at the same time, I will give you some up price also. You see, today say we have approved for $100, I can go up to $125 depending upon circumstances when you finalize the audit or whatever. It may take some time, or you achieve certain targets which we have discussed, that if I'm buying from you at X price, you must achieve it in achieve some turnover, some profitability, some other thing in the next 1 year. I'll give you more. If you can't achieve, then the same price will continue. I will not reduce it, but I won't give you more. So there, what they have said, in certain circumstances, you pay 25% now, balance can be paid in 18 months, subject to the variation, but it cannot go more than the valuation price. If valuation is 100, it can't go below 100, it can come below, but 18 months time you get. Then there is another, as I said earlier, under the definition of transfer under RBI Act, transfer includes pledge also. If I am pledging, it is tantamount to transfer. So for pledge, they have a separate regulation. Who can pledge to whom and for what? It means if I am a foreigner holding shares in an Indian company, can I pledge shares to an Indian lender for borrowing by the Indian company itself where I have invested? Can an investor itself or its group company associates can also pledge shares for borrowing by that person? Or can I pledge their shares overseas to a bank institution for borrowing by that foreign investor separately, no recourse to the Indian company as such? So there I have made a slide, I'll come to that. The pledge is also one of the modes of transfer, and it is specified as to what circumstances you can give. Now the issue comes, why I am putting under category of pricing. It says when you are pledging a share, when you pledge a share, at the time of pledge itself, you decide the fair value of the price of the share, not later, because pledge invocation may happen later. He says that time I will not, you don't decide the price today. So if pledge is invoked and shares are to be transferred, that time the price at the time of creation of pledge will be important, not at the time of invocation. Like you have, and then another interesting aspect which is modified in the last 1 year is swap. Swap means share to share, and this has implication under FDI also, under ODI also. Earlier it was allowed only FDI. Now ODI is also allowed, FDI allowed. It means you can have multiple kind of permanent combinations. I have mentioned the last row, ODI, FDI, ODI, FDI. So it means you have to combine both the regulation, ODI regulation, FDI regulation for the purpose swap. And swap, of course, they have mentioned that it has to be fair value, and fair value has to be determined by a merchant banker only, not by chartered accountant. And then how to do it? It is by this swap itself is a big subject which may take many hours, so I will not discuss, I will leave it here. So you understand what it says. I have made a slide somewhere. So this is an important aspect. So now these slides basically cover what I have already covered in my, this is pledge, if you want to understand this pledge. Haji. Both. I said it is applicable for repatriable, including non-repatriable. Because it is in that regulation, it's specifically mentioned. There are two separate regulations on that. One is repatriation, one is not. But it is not given in Schedule 4. It is given in the main regulation as a separate regulation. So pledge of shares.
Sir, any transfer to person resident outside India is subject to a sectoral cap given in the FDI, right?
Of course.
So, sir, how will it be managed? I mean, how will come to know that sectoral limit or sectoral cap is not breached in particular investee company?
In which case? In which illustration?
Say, for example, if a person resident in India gives shares to person resident outside India. So,
a resident selling to resident outside India, right?
Gives a share to
resident
outside India.
So gift of shares, when you give the shares, so there is no money flowing out of it.
Correct, sir.
Right? It means generally you don't go to AD bank.
Correct.
You don't file Form FCTRS. Generally, you can ignore that. Right?
Okay.
Company today also, if a demat account, company also won't know about it.
Correct.
If it's physical, of course, company will know. And in case of a private limited company, I think last year Act was changed that in case of a demat shares of private limited company, unless the board of directors of the company approves the transfer, demat cannot be done. It means the depository cannot transfer automatically. Otherwise, in a private limited company, I can always sign a delivery slip and it goes to third party, which is not allowed in a private limited company because these are restricted by definition itself. So they have come out with the new regulation last year, that unless you have board of Indian company, you cannot transfer demat also. Now your question is, I am transferred to a foreign person. Foreign person, you are assuming individual or you are assuming company?
Individual.
Individual can be two categories. He is a declared NRI or non-declared NRI. Declared NRI means OCI or is a foreign passport holder or NRI, right? And he is a non-declared. He is not even declared in India. Nobody knows. Demat account is not classified as NRI or a non-resident. So there also demat account will be transferred, right? But if it is a private limited company, you are talking private limited company, you are talking about listed company.
Listed company, sir.
Listed company.
I mean, is there any declaration that needs to be obtained from a company?
Say again.
Is there any declaration or clarification needs to be obtained from an investee company that their sectoral cap is
here, yes, coming to that. Can a person resident outside India, in your case NRI, right?
Correct, sir.
Can that NRI acquire shares by way of gift or otherwise of an Indian listed company just like this? Answer is no. It is not permissible. As and when it comes to the knowledge of the Indian company, then it is a prohibition. Because an NRI can acquire shares of a listed company either by a gift or by a stock exchange only under Schedule 3 of FEMA on a repatriation basis by opening a separate PIS account. And if it is a non-repatriation, then it is Schedule 4. Listed company, unlimited, you can buy. I'll come to that. A non-resident Indian can acquire without any limit shares on a non-repatriation basis from Indian person. But as Jay asked me, your question was not whether allowed or not. You are allowed who will come to and when.
Yes.
Right?
Especially the breaching of that sectoral cap given in the FDI in case of company.
No. I'm saying forget about sectoral cap. Otherwise also, who will come to and how will it come to know? Then that's saying if it is a declared non-resident, then of course it can't be transferred. It can't be transferred. No, FLA return will come later. The FLA come only if you have FDI, because this is not an FDI. So your question is how will it be monitored?
Yes.
And especially in case of a sector which is prohibited, there are caps. Right.
Yes.
So you see there the monitoring has to be done by the company itself. The company has to know who is my shareholder. At any point in time, company gets an idea or gets a feeling that the person who's acquiring the shares is a non-resident, then company has to see that whether it falls into that category or not, with the cap. And if you are asking me how will the listed company shares are done, it is through the RBI portal, na? It is SEBI. See, RBI has a portal which is linked to stock exchanges, wherein, assuming, in a case I just referred that this Blinkit has put a cap of 49.5%. So you see, every company, I'll come to that slide later, that how much, what percentage can be given to a non-resident under NRI category, which is Schedule 3, or under FEI category, which is Schedule 1, Schedule 2. And FDI is not important. FDI is in any case is monitored. You are talking about which is not monitored, right? So every day, through NSE, BSE, SEBI, RBI updates its portal company-wise as to what is the foreign equity by FPIs and by NRI separately.
Okay.
And as soon as that limit is near to that, so they have a mechanism to alert stock exchanges, please don't allow any NRI or any FPI to purchase. If it's a repatriation, because non-repatriation, nobody comes to know, because that is done to the NRO account. It is not done to the specific PIS account or Schedule 3. So this monitoring is done of listed shares by RBI via SEBI and NSE, BSE.
Okay,
and if you search Google, say RBI, FPI, NRI, threshold limits or threshold, you will find that.
Okay, sir.
And every day it is done, because many companies have a system, I'll come to the slide, that they can increase their FPI limit up to the FDI limit which is permissible. Like I'm allowed 100% in a company, say Manfish, I'm allowed 100% FDI. So I can fix my limit up to 49% or 74% or 30%, but not below 24%, because 24% is the minimum. FPIs can invest up to 24% in listed company even under prohibited sector, like real estate, right?
Okay.
Listed otherwise barred. ITC is a tobacco company, and you have FPI investments there up to 24%. Up to 24% through Schedule 2, FPIs can acquire up to 25%, or any company for that matter. Above 24%, it depends on sectoral cap, which each company will define how much they want to go.
Okay.
If they today say 49%, they can't come to 40% tomorrow. It has to be 49 and above, and it can go up to the maximum.
Okay.
Like in case of manufacturing, 100%. In case of telecom, also 100% now, because a little bit lower. And in case of certain other sectors, up to the limit only. And those companies pass a resolution of board and the special resolution of shareholders, inform RBI, then RBI keeps a trap under that portal.
Okay, sir.
Clear?
Yeah. Thank you, sir.
Right, sir? Understood. So here it is a pledge. Pledge is by whom? Just see. Any person being a promoter of a company registered in India, means borrowing company, which has raised ECB in compliance with the foreign exchange lending regulations, may pledge the shares of the borrowing company, that of its associate resident companies, for its securing external commercial borrowings. And 2 says, any person resident outside India holding equity in an Indian company may pledge those foreign holding in the Indian company in favor of bank in India to secure facilities extended to such Indian company for bona fide purpose, in favor of overseas bank to secure facilities for such person outside India who is a promoter of Indian company or overseas group company of that company, in favor of NBFC registered with RBI for credit to such Indian company for bona fide purpose. It means there are various categories under which you can do it. Now the question comes for the invocation, what happens? Invocation has to be at the pricing guidelines, and I said pledge is to be at the time of pledge itself, not at the time of invocation. And there are other regulations also. Suppose I have mortgaged my immobile property to a foreign person, right, and immovable assets, and there are shares also. And as per law, foreign investor cannot hold immobile property in India. Then what to do? So the FEMA regulation provides that when that pledge is invoked and I get a right over immovable property, I can't get the title transferred to my name. I have to sell it, and the net proceeds I can take it abroad. Right? कितना time भाई? डेढ़ बजे तक तो देखता हूँ अब थोड़ा फास्ट देखता हूँ. I think most of it I have covered already. Swap I have already discussed. I will not further discuss it. Right? Cross-border source, I've said that now they have amended ODI, FDI, FDI, all kinds of permutation combinations are covered. So these two slides if you read, because I don't have anything to discuss further on this, because accepting that this is not permissible. Swap of shares, cross-border is permissible. And answer? No. It is only equity shares. Yes, this is important. Investment in listed Indian company by President of India. So what it says, yes, this is the three categories wherein you can invest. One is Schedule 1, means FDI, which foreign investor can buy shares on a stock exchange which is classified as FDI, which I have to file Form FCGPR, right? It is only that promoter company which is already a shareholder and it has control over that company, right? Control is what? By shareholding, which is more than 50%. And by ownership, and control is majority of directors, and then you have control through the agreements, as I read earlier. Battery low. अरे बनाने का चार्जर लगाऊंगा इसमें याद रहा है बनाना जरा इनको यार चार्जर लगाएंगे चार्जर लगाना पड़ेगा चार्जर बैटरी लो होगी मेरी हाँ वो तो सब चलता है इसकी ना चलेगी तो ये तो जा रहे हैं हमारे खोलो अच्छा Getting me? So, if the foreign investor is a promoter and has control over the Indian company, simple example, Unilever, Hindustan Lever. It has more than 50%. If it wants to acquire more shares in an Indian company under as a FDI category, it can acquire through stock exchange and file Form FCGPR, that is permissible. This is one category. Second is Schedule 2. Schedule 2 is what? Which we'll discuss in detail later. Foreign portfolio investors through stock exchanges of which companies? Listed company and to be listed company. Listed company is already listed. To be listed which company? Not any listed company which will list after 3 years, 5 years. To be listed company which has filed offer document with the SEBI and they are in the process of getting listed. Only that company, not any company for that matter that you do it today and then I will list after 5 years. Not that company. Earlier they were lying, but not now. Third is Schedule 3, which is NRI, OCI in individual name on repatriation basis, subject to some condition, which I will discuss when I come to Schedule 3. Schedule 4, NRI, OCIs and their trust company, etc. on non-repatriation basis, unlimited, on stock exchange, which is non-repatriable out of Indian funds. Even if funds from abroad, it will become non-repatriable on sale, right? And repatriation, as I said, will be governed by other regulations under other USD 1 million scheme or current income. So this is the three categories. Other than these three categories, nobody can acquire shares on a stock exchange. Like gentleman was saying that if a resident is transferring shares as a gift, the gift will be non-repatriable. Non-repatriation allowed है, ठीक है ना जी? Non-repatriable is allowed. Non-repatriable is also not counted for the purpose of prohibited sector, so that is more or less permitted. Nobody will be available. But if he wants it to be a repatriable rights, it has to be either FDI, for which you have to file form, FCGP, etc., or it has to be Schedule 3 through the stock exchange, not otherwise. So other than these three categories, you cannot do it. So this is important here. It says other than above category, including FOCC, cannot make investment through secondary market, either as an investment or even as a stock in trade, right? But irrespective of the amount of percentage. Some people are saying, it was practical, I have seen over the last 3-4 years, any consultant will give every view that how does it matter, sir, 1% of the total investment, 2% total investment, sir. मैंने कहा 1% of Reliance Industries balance sheet is how much? Your 5 companies will get merged into that 1%. Right or wrong? So RBI has nowhere defined that you up to a threshold limit you can do whatever you want. 1% balance sheet of Adani and maybe Birla companies will be more than many companies total balance sheet total, isn't it? So it is irrespective of percentage. You cannot invest in that. It is just prohibited. However, a person at India, not the question sometimes comes, then how do I acquire shares of a listed company in India? That is, you come as an investor, you get shares allotted under preferential allotment from the Indian listed company, or part of it you buy from a stock exchange, their form file FCGP or FCTRS with the consent of the Indian company's board of directors that we are allowing foreign investor to invest 20% in this company, in my company. 10% I am giving as a preferential allotment, 10% to acquire from stock exchange because it is allowed, right? So that is permissible when you file from FCGP or FCGPR or FCTRS, and secondly, not otherwise. Same thing applies to FOCC, same principle applies. Merger, demerger, amalgamation, Indian companies, so far as it is approved by NCLT or MCA in case of small companies, and other companies which are eligible to the MCA route. So long as they are not under approval, the active not under approval route, government approval route, it's an automatic route. So as per the court approval and valuation as the court has approved, shares can be allotted to a foreign investor under a demerger or amalgamation or demerger scheme. Merger, the company is wound up and you get shares of new company. Demerger, you get additional shares of the other company. So both are permissible so long as it is approved and the activities are not under approval. If it is an approval route, then you take approval government of India. Otherwise, it is permissible. Generally, there are no issues. There are no pricing guidelines here. Whatever is decided by the court and CLT in terms of pricing, as per exchange ratio, that is permissible. In case of demerger, there is no exchange rate. It is generally a mirror image, because if you hold one share in the demerged entity, you get say one share in the resulting entity. So it is a mirror image, so no valuations are required on that purpose. So right issue and bonus issue. Right issue, you all understand what is right issue. Right issue, the principle here is, if it is simple right issue, that I am giving rights entitlement to all the shareholders, resident including non-residents, at a price irrespective of fair value, and all those shareholders who have got entitlement, they apply in the same ratio. Principally, if the mirror image remains same, what is my shareholding today in terms of percentage remains same individually. After post issue, the pricing guidelines are not applicable, and it is provided in the firms portal manual that in case of right issue, valuation is not required. And even for SEBI IPO, SEBI means listed company, formula is not prescribed. RBI say they should be equal to all the shareholders, and you decide whatever methodology the company wants. We are not sitting on judgment at what price you give it. So long it is below, not below par value, and it is parallel. It is like akin to bonus. You see, bonus you give, everybody gets bonus, everybody's share increases, everything remains same. Right issue you give at a price, whatever price you give, everything remains same, is fine. But as soon as that mirror image changes, which can be in number of ways. One is resident has not subscribed, right? And non-resident's percentage automatically increases. On non-resident doesn't subscribe, resident's percent increases. Or resident applies additional shares at the cost of non-resident, then percentage changes. Both of them have applied, but there are unsubscribed number of shares, which happens in a IPO generally. So they give some shares to a person who has applied for additional shares, right? So this is covered by a separate section 62(1)(b) some clause that in case of an unsubscribed portion, the board of directors can allot shares to somebody else who is not a shareholder, so long as it is not disadvantageous to the company. So they can do it. But ultimately, what RBI says, if my mirror image doesn't change, you do valuation not required. If my mirror image changes by whatever reason, you have to have valuation. Fair price for valuation लेनी पड़ेगी, and share has to be issued at fair value. Right? So this is a fundamental principle. No, if you want to reach, we can read what it says, and bonus is, of course, is an accounting entry. So there is nothing. Yes, if you want to allot bonus shares on a disproportionate basis, right? So that is not permissible. Like I think Reliance Power or some company had given long back after public issue a bonus share to the specified non-promoter shareholders. Now the question comes, in case of a prohibited sector which are there for many years, like ITC, and like this company in Goa listed in Bombay Stock Exchange, NSE some corp name, who's guessing which name? Delta Corp. Yes. Delta Corp is that Modi's company, Zia Modi's brother. So that company is into casino. It's the only listed company on casino, and FPI is 24% because they can't induct any other FDI. So उसमें bonus share कैसे जाएंगे? Because the prohibited sector, now they have last year come up in April 25, that in case of a prohibited sector like this, I am giving two examples, tobacco ITC and casino this. So there they say bonus shares can be given so long as there is no disproportionate bonus, means mirror image remains, so you can do it. So this is an advantage. Otherwise bonus share no issue. Right issue is, as I said, very simple. Go by whatever pricing you want. If the mirror image remains same, no issue. If the changes, you have to have fair price. Simple. Hanji? Yes. You have to file FCGR for any change in shareholding, in any case. Whether it is a bonus share, right issue, capital reduction, buyback, kuch bhi, where is changes. You see, why you file FCGR? Let me come to that. There is a new fundamental under firms portal called entity master. How many of you have heard about entity master? See entity master? What is entity master? Entity master is my entity master as a company. So this captures what is my name, my activities, NSE code सब करता है. बाद में last में schedule है. Schedule will capture what is my current shareholding, what it says, FPI, foreign product investors, FDI, indirect foreign investment, NRI, and balance. Anytime there is any change, it will automatically go under change. See the problem. If there is a transfer between two parties, company is not involved, company not even aware. Who has to file FCTRS? The Indian person, either seller or buyer. He has to obtain business user, he has to enter the site, he has to upload the form, and he has to mention there whether this entity master is to be changed. You will say yes because you not change. Just yes karoge, it will get changed there, right? And the company has to then download and see what is my existing structure. Same hai ki nahi hai. If nahi same hai, so it has to देन इन्फॉर्म आरबीआई अभी इसको चेंज करो, गलती हो गई किसी से. तो क्या होता है, व्हेन यू फाइल FCTRS स्पेशली, इट इज़ फाइल्ड बाय द other party, not the company not involved. FCGPR is filed by the company, right? So company has to file FCGPR for any fresh issue of shares under whatever category, any category you discuss, it has to file FCGPR to make it update, right? Even for split of share from 10 rupees to 2 rupees, 2 rupees to 1 share, consolidation in case of capital reduction, whatever. But transfer of shares is done by third party. It is not, company not even involved, company not even aware that there is a transfer happening. So then you see that fellow will say yes or no, what are happening. The entity master goes, is changed. So then entity master has to be reviewed by the company every time to see that it is as per my records. So that is the reason why it is so, right? So go ahead. I think right issue, anything you want to discuss, anybody has any issue? I think this is clear. One liner, mirror image changes, fair value, no mirror changes, whatever value. This is what I mentioned in the crux of the issue. Now we come to, yes sir.
In the case of wholly owned subsidiaries, the nominee shareholder only hold one share. So the percentages are 99.99% and 0.01%. So I'm issuing right shares to the 99.99%. The percentage will remain same, but the number of shares will get increased. So still I'll get a valuation report in that case.
In case of right issue?
Yes.
Right issue, so there is a catch here, because it says the share price to the non-resident should be the same as is given to a resident shareholder. Here in case 100% holding is 100% shareholding by a foreigner, there is no resident shareholder. The nominee may be Indian, the nominee may also be a foreigner, isn't it? Generally, if you keep a nominee shareholder of one share, I'm not saying percentage because I'm not getting percentage, but when you make me nominee, one share good enough for me. Now why you give me 1% or 10 shares? Also give me one share. If I'm assuming one share, I'm a nominee, I'm an Indian resident, assuming. So, but I'm not, I am holding on behalf of the foreign company, and I will issue shares to the foreign company. If right issue, I will give the offer to this nominee because he's my registered shareholder, but ultimately shares will be subscribed by the beneficial owner 100%. So I've taken a view. In that case, don't play very smart. Bring your right issue somewhere near the fair market value, or at least your book value. Don't make it par value, otherwise RBI may say that you are contravening this sentence, because it is no fair value only in case of a offer is given to a non-resident equivalent to given to non-resident. Resident पर है नहीं कोई, they no non-resident. So generally इस केस में क्या करते हैं, we do it at a book value or at a fair value, because it doesn't matter to me ना. I am 100% shareholder. Whether you give me 2 shares with 100 premium or 5 shares with 10 premium, it doesn't make a difference to me, isn't it? And tomorrow if I want to increase my shares, I can issue bonus share and then also increase it without problem. So that is a practical part of it. But yes, there is a catch in the master directions on this.
Okay. Thank you.
Clear na?
Yes.
Clear? So this is indirect. This will take some time. So 1:30 I have to close, right? So what time we'll decide? 1:30 na? 1:30 close na? Better because it is becoming too lengthy now na, because people listening to 4 hours also become. So what I do, it is 55 minutes, right? Indirect investment, let me start, though it is a difficult subject for people to understand if those who have not done it. But let me start and I'll finish in 15 minutes, but I won't take much time, because just consider what I'm saying, then I think you'll get an idea. Like in accounting parlance, we always discuss about proportionate shareholding. So this slide, what it says, left hand side, there is an Indian company holding 15% in the 4-layer structure. Foreigner is investing 49% in each company, right? So effectively, if I go by proportionate holding, accounting terms generally, which we all understand, is this seem effective? Effective in class 49%, effective in 3 is 24.9 because 49 or 51%. Effectively, if I take all together, it is 92.49%. It means if this structure is 51% is Indian, 49% is through me direct. If I calculate everything, total effective holding is for 92.49%. 49 is my own, balance it through this. So this is accounting. So this is, but this is not relevant for FEMA. FEMA relevant क्या है? FEMA relevant ये है. But the law is, let us read the law and then this is the illustration taken from a earlier press note of DIPPIT, which is not now reproduced in the master direction anywhere. This is old history. Somebody was asking me that are all these AD circulars are reproduced in the master directions or not. I said they are referred. Sometimes they are not fully reproduced. There may be 10 lines, they reproduce only 2 lines or 3 lines, because otherwise 7 lines they say you read separately, because in each master directions, and they mention which circulars they have covered in this master direction in terms of coverage. But sometimes you have to read the master circular separately because it may contain more information then. So this is one of that illustration. So what it says, FOCC किसको मानते हैं हम? FOC वो कंपनी है जिस कंपनी ने इंडियन कंपनी को आइदर ओनरशिप है या कंट्रोल है. Control is by way of board of directors or by way of agreements, shared agreement. So I am not discussing control. Because control is a very different kind of thing. There are many decisions of under SEBI regulation by Supreme Court and High Court and SAT and Appellate Board on this control definition. If somebody wants, I can share those case laws. So there they have defined in number of cases which category control is exercised, because some PE comes 10%, 25%, 30%, 5%, then they have veto rights, then they don't have veto rights, then a lot of things. So those old judgments, I think 10 years back, 8 years back, are very elaborate, and they say so long as I have a steering in my hand and somebody is putting small brakes in terms of what I do, it is fine, I'm not under control. But if he has full control on the brakes, then my steering has no value, so that is control. So this is what they have mentioned in the court judgment itself. So I am assuming in 99% cases, we will not discuss the control part, we will discuss the ownership part. Let us consider ownership, it comes to control automatically. 50% plus. I don't say 51%. In some FEMA, RBI regulation, it's a 51%. But otherwise, if I say ownership, it's a 50% plus 1 share. Right? That becomes more than 50%. So if a foreign company, assuming a simple case, has more than 50% or even 50%, 50% and above, because 50% becomes equal. So under defined, it says own or controlled. So they say it is not Indian controlled, it is joint control. So we'll treat it as a foreign control. 50% plus is a foreign owned, right? So it becomes FOCC, foreign owned and owned and controlled, right? Either or controlled. So this becomes FOCC. अब इसकी percentage कैसी होगी determined? If I'm FOCC, it means any downstream investment I make in layer 2 will be governed by same FDI rule which I am governed. FDI rules क्या कहता है? I am governed by FDI rules even if I have 1% of foreign equity, FDI. It is not such that I must have 50%. 50% होगा तो मुझे डाउनस्ट्रीम इन्वेस्टमेंट के अंदर तकलीफ है, उसको कोई तकलीफ नहीं है. Some people say if I have only 1%, then you see why should apply? Should I only when I become a FOCC? Answer is no. At first level, any FDI you have to comply with the law of FDI regulation Schedule 1. Downstream will apply only if you have more than 50 if you have FOCC only. Let us clear, FOCC is a company where foreign investors has 50% plus. 50% is total investment. It means FDI directly, one or more person, or even indirect. What is that? I will discuss that. It means I am in one company, I have some foreign investment directly, some through an Indian company, but which is FOCC. So that is also counted here for it to become FOCC, right? So if I am FOCC, then there is an issue of downstream investment. If there is no FOCC, then only first level I have to cover, second layer I have not to cover. So how it is done? Left-hand side, foreign investor is less than 50%. So this is IOCC. IOCC, below it is a downstream investment. So in this company, no FDI regulation will apply. It means company below, downstream investment company, is can do whatever it want, no FDI regulation will apply. It can do prohibited sector, it can do any sector under government approval route. Second, middle, 50% are above foreign equity, it becomes FOCC. Downstream also becomes FDI company, so it has to comply with it. What is the percentage in this company? The percentage in this company will be not proportionate. Not proportionate. If I say proportionate, it's 50% assuming, then it is say 26%, it is 13% हो गया, 80 हो गया तो 40, वो नहीं होगा. It will be the percentage the middle company, first company has in the last company. It means 26 or 80% of same रहेगी इसकी foreign equity. But if it is a 100% subsidiary, third category, 100% wholly subsidiary, then it will not be 100%, it will be the FDI which was there in the first layer company from the overseas. It means it will be 75%, it is a mirror image. As I call it, will be a mirror image of the holding company. So this is what it says in that three column. Where a company is a wholly owned subsidiary of company Y, which own 100%, then it will be the same percentage. So coming back to this, it means if I am wholly owned subsidiary, then FDI will be calculated as the FDI which I have in my company. It is mirror image. If it less than 100%, not wholly owned subsidiary, then it will be whatever investment I make in this company. So it means first company is out, third company is same of holding company, which is 50% to 75%, 75% say. Middle company is 26-80%. Now the question comes, what is the status of the downstream company in the middle part? If at 26%, it is IOCC. If 80%, it is FOCC, right? FOCC and IOCC we have to calculate at each level. You understand? I think you asked the question now, blink it, right? So this is how you calculate. Any questions on this, so then I go forward. Middle समझ आया ना? Left you have understood, less than 50%, no problem. Right hand side you have understood 100% subsidiary, then the mirror image of the holding company. Middle company में क्या हो गया? More than 50%, but I am not wholly owned subsidiary. So for the purpose of compliance of FDI, NDI rules, for the purpose of FDI and compliances, I will treat this downstream company too with FDI, which is how much, which Indian company one has invested, 26%, 80%. से लिखा ना ऑब्लिक लिखा ना मैंने ये इसको मान के चलो ये दो पार्ट है. थर्ड इज टू एग्जांपल्स. वन एग्जांपल 26%, सेकंड 80%. 26, 80 होगा. तो आई थिंक आई विल स्प्लिट इट नेक्स्ट टाइम इनटू टू पार्ट्स. 26%, 80% हो गया. 26 है तो ये IOCC हो गया, 80 है तो ये FOCC हो गया. ठीक है, FOCC होगा तो सेम रूल अप्लाई. नाउ हिज जेंटलमैन्स इशू दैट ब्लिंकिट कैसे करती है विद जोमेटो, उन्होंने क्या कर दिया 49%. इट मीन दैट हैज कम इनटू कैटेगरी 1. अंडरस्टैंड? नीचे उसको अप्लाई नहीं करता आप. और कमिंग टू द सेकंड वन 26%, नीचे अप्लाई नहीं करता मेरे को. अभी हमने क्या किया कंपनी में, फर्स्ट FDI है, सेकंड में किया लेस देन 50%, थर्ड कंपनी मेरी फ्री हो गई. आई कैन डू वट एवर आई वॉन्ट, स्पेशली इन ए रिटेल आउटफिट, नॉट अदरवाइज. जनरली पीपल डू इट इन प्राइवेट सेक्टर और रिटेल आउटफिट. इसका बेस्ट एग्जाम्पल अगर पढ़ना पब्लिक डोमेन में पढ़ना है, वैसे तो वी कांट शेयर अदर स्ट्रक्चर्स. दिस इज Paytm. When it came, so JM Financial had made one chart. It just came to me, I don't know from where. So that chart is a lot of things here. So he is into insurance, life insurance, property sector, a lot of things is happening through the Paytm. तो जहाँ भी उसको लगा कि मेरे को दिक्कत होगी, because FOCC है, तो उसको IOC के अंदर उसने कहा खुद से ले लिए 51%, बाकी वो ऊपर दे दिए. तो अपना ले 51%, ही इज इंडियन रेजिडेंट, तो सारी कंपनी सारा स्ट्रक्चर उसका फ्री हो गया. सब स्ट्रक्चर बन गया IOCC एक्सेप्टिंग Paytm. The whole structure is IOCC. Same thing is done by Zomato, same thing is done by Zepto, and a lot of people are doing it. Public domain I am talking, these are prevalent examples, right? Clear, sir? There is पंद्रह मिनट में ख़त्म नहीं होगा. चलो करता हूँ मैं 10 मिनट. I'll spend 10 minutes more on this and then I'll go further. Half an hour.
So, sir, what should be the case where 50-50 ownership is there? Just like, for example, Adani Wilmar was a joint venture. Between Adani and Wilmar was a Malaysian-based conglomerate.
50-50.
Yeah, so 50-50 made the rights were equal. And actually that was a JV, like 50-50 ownership, 50-50 board seats, 50-50 everything. So in that case, it becomes a little bit tricky.
No, अगर आप section 90 का form देखा, आपने band 2 देखा है, band 1 देखा है, so they say 3 categories: nominal value, voting rights and dividend rights. 3 है ना?
Right.
तो इसमें ऐसी same है. अगर तो ownership है, तो ownership is by way of nominal shares. Clear? As I said, it's out diluted capital. It means you go by nominal capital, including convertible instruments taken into consideration even today. Like in case of this Zomato, they have considered the instruments which are convertible today itself as per the nominal value to make it less than 50%. Right? But in case of a rights by way of an agreement separately, the control definition is anything, everything, whether through JV agreement, whether through shared agreement. If you have a control over board of directors of more than 50%, it is a FOCC.
Right. But
more than 50%, not 50%. 50-50 तो फिर हाँ 50-50 में क्या होगा? Share capital में they have defined 50 means equal हो गया तो equal में it will fall through foreign. FOC बन जाएगी वो.
So conservatively then FOC.
50 है तो FOC बन जाएगी.
Okay.
50 plus 50 equal and above.
Okay.
If you see all my slides, I have used the word 50 plus 50 plus 50 second सीधा equal to or 50 above. I have not said above. वहाँ क्या less than 50 तो right. Anything 50-50 will fall on foreign capital, right? So what are the regulations which apply? If I am FOCC, if I want to make downstream investment, it means all regulations will apply to me. FOC will apply to downstream investment. Whether it is pricing regulation, whether it is sectoral caps, whether it is filing. Filing is different. I file FCGPR, there I file DI form, then there are filing. I will come to that later. And the only important part here is how do I fund that company? The downstream investment. They say you can fund it only out of 2 funding mode. Either bring in funds from abroad as FDI or as ECB, or do it through your internal accruals. Internal accruals is what? Profits less taxes. Total. Assuming I have accumulated profits of 100 crores and I have already made investments about 80 crores in the downstream investment companies. I have left with 20 crores only, right? And next time I do it, I have to consider that. But problem arises, my audited balance sheets are of March 26 will be available in August, September 26, and next year will be available much later. What do? I can't do it on a non-audit provisional account because I have given in my slide, I will push through that accounting standards and Ind AS also has a provision for interim financial reporting signed by the auditors, statutory auditors. If I have interim financial statement prepared and signed by the auditor, it can be termed as audited statements. Even if it is received later, I have no problem. Today I decide that as on today's date, I want to do it. I decide some figure which is within the law, and audited accounts are available after 30-40 days. That's not, but the date is today is fine. So only interim financial statements which are audited as per AS 18 or concerned Ind AS, that is can be taken care, though it's not mentioned anywhere, but this is the practical orientation. Or you can do it only out of these 2, internal accruals or out of foreign funding. You can't do it from borrowings. Whether it is NCD, whether it is ICD, whether it is bank borrowing, any borrowing not permitted. Now the question came, can I issue fresh shares to Indian residents and then from there I can do it? There was confusion, but it is finally settled now. It was done by Zomato also, and RBI, we attended seminar in Bombay, so they have said categorically, we are only barring you for borrowings. If Indian shareholders invest in the Indian company, Indian money that you can use for downstream investment without recourse to these 2 clauses of foreign money or internal accrual. So it means Indians investing in the share capital total, including premium, can be downstreamed, which is permissible, right? And other thing here is that it approved by the board and shareholder agreement. Requisite funds might come from abroad or borrowed fund that I have discussed. And first level company is to comply with all the law of the land, including FCGPR. The downstream have to file DI or whatever. And the first level company has to comply with the law. And the statutory auditor of that company has to give a report every year, which will be part of board report also of the company that DI has been fully complied with. And these are definitions, own and control, which I have already discussed in detail. And total foreign investment is investment FDI and through the indirect also. And this is what I have already discussed, that Zomato and this. And this, I think, a new para is I have added in the morning, second para. As long as Zomato continues to be IOCC, investment by Zomato into Blinkit will be considered as domestic investment. Blinkit currently operates an online marketing services, buying and selling with the inventory model. Under FDI policy, inventory model is prohibited. So that's why they have done it, because they have made IOCC, niche jo marji karo aap. Okay? And you can do multi-brand also, you do whatever you want. And then I have said you can raise Indian capital and then you can use it. Even IPO, when you use Indian IPO, that also can be used, no issue. And what is permitted, I have listed out certain things. I think you can read it at some point of time. And earlier, you see, there was issue whether swap is allowed or not from downstream, whether deferred consideration is also allowed or not. There were different views. So now they have, the government has amended this by way of circular last year. I think I have omitted to mention the circular reference. It came last year. Now they say downstream investment equivalent to whatever first company can do, second can do. It means you can do it through deferred also, you can do swap also, everything allowed. This is what I mentioned, that what is allowed under 23 is allowed elsewhere. So everything is allowed, but is allowed to a FDI company. And not permitted borrowed funds, and downstream investment is covered. Internal accruals I have already discussed with you, that interim balance sheets, interim audit accounts can be taken. So that is permissible. And then bonus shares. If I issue bonus share out of my profits, then bonus share goes to capital. Can I still treat it as internal accruals? Answer is yes. I have given a write-up on this, that bonus shares issued out of retained earnings can be treated as retained earning for the purpose of downstream investments. And why I am saying so, in the annual return of FLA, when you file, there is a description of how to calculate internal accruals and how to calculate internal accruals. These two terms have come from IMF manual of balance of payments, wherein they say that investment as FDI which comes to India, any retained earnings is also FDI. Because when you report in FLA, you report FDI, you also report retained earnings. It is FDI. So that is what I have given reference of International Monetary Fund two slides, but it is out of I think 300, 400 pages, only abstract I have given. Abstract, the para number is given same as in the manual, like 3.18 and 8.16. So very, very interesting. Now it is authentic. And now I had made for my internal purpose, how do I calculate downstream investment as of today? So you take last audited balance sheet, then you calculate internal accruals, then you take loans and advances, ICD given to third party, which is part of downstream investment, then how much you are given, how much you balance allowed, etc., etc. Sometimes people give corporate guarantees. Corporate guarantees, they say it's a non-fund based. I say no, non-fund based hoga, like in the corporate guarantee, if not for yourself, somebody else, you reduce it from your working as a, not that you can do it otherwise. So this is my interpretation. And filing, you file DI form, the investing company, and then the other company, it has to open an entity master, then it has to enter there that I am having indirect investment of so much, because it has to be self-mentioned. It will not come through automatically from any filing system. Layer 2 has to update entity master. First layer company will obtain a certificate from chartered auditors. Sectoral audit has to confirm that it is all in law, board report also. And DI, what is DI? I have mentioned it. Mode of investment I have mentioned here. That issuance of equity shares is from DI. Transfer of to FOC is also DI. When you transfer and it goes to a foreign resident, then you file FCTRS. Right? And similarly, if it is otherwise, then I covered LLP also. So I am not going into details of this, because these can be specific to the facts and circumstances, but here there is a chart for you to refer to. This is abstracting more or less from manual, so this is all authentic. There can be some more variation, but ultimately understanding is simple. If shares are going to a foreign investor on a repatriation basis, it has to be reflected in the company. It means since it is existing shares, it has to be FCTRS. If it is not going abroad, it is happening within India itself, then there is no need to file FCTRS, because entity master will not accept it, because this is not transfer of shares as FDI. And hedging is another subject matter which people generally forget about it. This is a specific requirement. People are not doing it. It's a different matter because it is very costly to hedge FDI into India. But there is a separate regulation on this, that foreigners can hedge their foreign investments up to market value investment of dividend receivable, hedge risk, and products are available in INR also. Then operational guidance are given, etc. I've just given it there. There is separate regulation for this. This is statutory auditor, but it says if a foreign investor has made an investment and there is a condition that some foreign firm will be the auditor, then it has, for international network firm will be the auditor, then there should be a joint auditor or somebody else also must also be auditor. Not necessarily Indian, it can be joint foreign also, but it can't be single auditor. This is a very important aspect. So generally what we do when we incorporate companies and when we have JVs, we say that you keep it as a separate arrangement, don't put it into the agreement itself. Agreement mein dalte you have to have a joint auditor. And no foreign company will have joint auditor which are both are big four. And one big four and one local, I think nobody will accept. So this is an important aspect. And many people forget about it. Now coming to specific schedules, 2, 3, 4, 5, 6, right? So 2 is for FPI, foreign portfolio investors, which are registered with SEBI. They are earlier called foreign institutional investor, now they call FPIs. FPIs can invest in the stock exchange, listed or to be listed who have filed documents, offer document with the SEBI, not anybody who can be listed after 5 years. क्या चीज़? नहीं, if you filed with SEBI, it's good enough. Now, offer document you filed with SEBI, whatever stage. And exchange traded also is approved. So here what it says, there is a regulation in terms of each FPI and investor group also. It means if some FPIs are related to each other, like a related party, some common control, common shareholding also, they will be treated as one FPI, not separate FPIs. So this is as per the SEBI regulation. For more information, we have to read SEBI regulation. But here, what I mentioned is about FEMA. What it says, single FPI cannot invest more than 10%, less than 10%. Okay? And 24% is the aggregate limit for any sector, even prohibited. 24% can be increased to ceiling as per FDI, up to which is permissible. Automatic 100%, otherwise up to the limit it is permissible. Like in case of Zomato, they have said 48.5, otherwise it is 100% allowed, right? In case of manufacturing, 100%, but they can put whatever ceiling they want. Like in case of banking sector, it can't be more than 74%, they mentioned 74%, like HDFC and ICAI Bank, etc. ICAI Bank and HDFC Bank both are FOCC. Both are FOCC rated. So they have exemption for downstream investment only in case of strategic investments, not for anything else. They have to comply with the DI regulation. So, as gentleman is saying, how it is monitored, this is monitored through SEBI and RBI portal on a daily basis. These limits. Last second paragraph, aggregate limit for prohibited sector in 24%. You can't reduce below 24%. It has to be 24 plus, right? Prohibited allowed in other way in any sector. Once you increase it, you can't reduce it. 2 or more FEIs will be clubbed together if they are of the same. This thing, purchase and sale, they can, if they breach by any chance, they go beyond their limit. 5 working days they have to come back. If they don't come back, FPI will become FDI. It means you have to file FCGPR. There is a separate chapter in manual on conversion of FPI into FDI, on how to file the form, because there is no fresh issue, but you have to file form FCGPR for converting your FPI into FDI. Once it becomes FDI, it can't go back to FPI. Once done, it is always done. And purchase and sale is permissible. In case of unlisted, it has to be internationally accepted formula. In case of listed, of course, it is as per SEBI. Before listed, it has to be as per the internationally accepted formula. Short selling, lending, borrowing is also allowed. Units of domestic mutual funds and category 3 alternative funds also is permissible. Units of REITs and InvITs is also allowed. It means AIF3 mutual funds and REITs and InvITs are allowed by FPI under this regulation. Mode of payment is from abroad. They can open special foreign currency account. They have open SNNR, special non account in India through which they can do it, and sale proceeds can go to either abroad or to these accounts. Generally, it is routed through this account. Next is same case, but NRI and OCI, repatriation through stock exchange. So there also here also is a condition. They have to route through a designated branch of a bank, not generally and anywhere, everywhere. Then limit is 5%, one individual, total is 10%, aggregated 24% by shareholder resolution. What it includes? It includes equity instrument, listed company. Second is units or domestic mutual funds, where equity is more than 50%. Public sector enterprise is under the disinvestment scheme, national pension fund, and they can also invest in exchange traded derivatives. And mode of payment is inward remittance or NRI account, but they have to designate NRI account as a special NRI-PIS account. It means in this NRI account, only transaction for these 4 categories will be listed, and no other matter, other thing can be done through the other NRI account. But when it comes to non-repatriable, then you can use NRO account. There is no separate NRO-PIS. It was there earlier, but it is gone now. NRE-PIS is there. There is no NRO-PIS because NRO से भी आप शेयर ले सकते हो लिस्टेड कंपनी के, वो आने रहे. And remittance is permissible subject to payment of taxes. 4 is non-repatriation, which we are talking. Most important part here is valuation guidelines don't apply, excepting Companies Act, right? And you can do whatever sector is permissible. You can do prohibited, you can do tobacco, you can do whatever you want. Only sector which are prohibited. Then what you can do without limit 3 categories: equity instruments, stock exchange, units of investment vehicles, which is REITs, SVIs and AIF, and limited liability partnership, and convertible notes of a startup company. And this investment here is deemed as a domestic investment. It means investment under Schedule 4 is not counted for the purpose of determining FOCC or IOCC. It is to be excluded, which is on non-repatriation basis. And then purchase of units of mutual fund, more than 50% equity. Then prohibition is Nidhi company, agriculture, plantation, real estate, business and construction. Here agriculture, plantation is fully prohibited. FDI it was still certain allowed, agriculture 5 and 6. Here it is fully prohibited. It means nothing in agriculture you can do under Schedule 4. Plantation is fully prohibited. You can't even do tobacco, you can't, tea, cardamom, kuch nahi kar sakte aap. It is fully prohibited. There is no relaxation here. This is an important aspect, right? And then mode of payment is either abroad from NRO account, and same thing is it will all be credited to your NRO account, not otherwise. Here the issue was, who is an NRI OCI? As I said, a company, trust or partnership firm incorporated outside India, incorporated, not registered. It means firm must be incorporated or registered outside India, which is owned and controlled by NRI. It means balance 49% can be held by any foreigner or foreign company, not necessary. It means if you can't do invest directly in India, you invest through foreign structure where 49% is foreign company, some Amazon, something, 51% is NRI. You come to India, invest in Schedule 4, all sectors are free to you. Retail is fully free to you. Lot of people are doing it, maybe not in the public domain. It means you can do prohibited sector through this route also, because that is not prohibited. And firm and proprietorship firm, you can do it on a non-repatriation basis. Here also there are certain sectors which are not permissible: agricultural, plantation and print media, real estate. And real estate is already defined under FDI 1. Mode of payment is same. It can't be, the only thing is you can't repatriate. You can repatriate under 1 million scheme. No current income, nothing, excepting current income. Then change in status under 6.5. Resident becomes a non-resident. Everything in India becomes non-repatriable. This is important aspect. It is not that Schedule 4 you invest, it becomes non-repatriation. Even if you become resident to non-resident, whatever you have in India becomes non-repatriable. Plus, non-repatriable funds have to come from abroad. You can't have swap. You can't have in-kind allotment of shares, like against dues payable or something. That is not Schedule 4. Schedule 4 is pure cash, money transfer. Schedule 1, you can have swap also, but swap is not available here. 5 is non-resident, other than they are specified by SEBI and RBI, sovereign funds, not discussing. And LLP, you can invest. FPIs can't invest, FCRA can't invest. It is invest only in those sectors where 100% under automatic route. It means which is not automatic 100%, you can't, right? And forms you have to file FDI LLP 1 for fresh and LLP 2 for transfer or divestment. Then FECI. FECI is a SEBI registered FECI who invest into an Indian venture, specified categories, which are these categories: biotechnology, IT-related hardware, nanotechnology, seed, research, dairy, poultry, production, biofuel, etc., etc. But if you're a startup, the startup is not necessarily in these fields. It means you can have. A big advantage here is the pricing guidelines don't apply here, neither at the time of issue, nor transfer, nor at the time of exit. It means at your negotiated price you can exempt. The difference between this and Schedule 1 is majorly that there is no pricing guideline, no valuation guidelines, but it is restricted to certain sectors which is not open to all, but startup is allowed. And only condition is that here it is only SEBI registered FBCI, not others. So the catch here is no valuation guideline. That is why people prefer it, but there are not many. Only high level people do it, not many people are doing it. And then you have investment vehicles, which is REITs, AIFs, and InvITs. So these are very specific. Only thing here is that if the manager or a sponsor is foreign owned and controlled, then investments are treated as foreign investments. If the manager and advisor is not a FOCC, it is owned by Indians, more than 50%, then what this AIF does is immaterial. It means they can do whatever they want, but only condition is AIF 3, you can only invest what FII you can invest in the listed security. There are some conditions attached, but there are very detailed SEBI regulations on AIF, all these things. So here also, what is important us to understand is, if the manager or investor advisor is not owned and controlled by foreigner, it means the equity or control is with the Indians, then AIF it is as an Indian. So foreigners can invest there, Indian can invest there, what you want. But if it is a FOCC, by chance, then AIF also becomes a FOCC, and then you have to comply with downstream investments. So this itself is a very advanced subject matter, which I am not discussing because not all of us will be doing it. I am doing for the first time in the last few months. I am involved in AIF 2 and AIF 3. So otherwise, I have also not handled it. Then Indian depository receipt. It means foreign company listing its shares in India. Only one company, Standard Chartered Bank, long back. Otherwise, no company is listed in India. So they have said that NRIs, FEIs can invest into that company. Since this is also very exceptional, I am not discussing, but this you can always find out. And then this is mode of payment, non-debt instrument clear. Mode of payment, I have already discussed. That mode of payment is very important here. Just have a look at this. It says Indian company issue equity instruments out of swap, import of goods, excluding pre-operative, pre-incorporation expenses, swap of equity. So generally, you see what happens in case of an incorporation company. Sometimes you send money to a consultant or you for incorporation company. So when you allot share, it has to be, money must come to the company. But prior to incorporation, it doesn't come to the company. It means it comes to a consultant or directly to the government account. So how do you do it? So these are called pre-incorporation expenses. Then there is a pre-operative expense. Maybe some other expense incurred for preparing a project report, appointment of some consultants here and there, not for incorporation, but for the project, etc. So there is a special regulation under FDI that how do you capitalize these transactions also, which are prior to company becoming operational, right? So, and including import of capital goods and machinery and equipment, which is other secondary ministry, and any payable to a foreigner, anything payable, royalty, dividend, technical know-how fee, import, or any other payment, whatever is payable, which is legitimate and payable, which is not overdue as per the law, you can allot shares against those dues also. It means any payable which are listed to you can also be converted into equity instrument or equity basically not instrument, only equity by filing FCGPR. Not necessarily that you have to pay it abroad. It can be retained in India and then you allot shares. So there are separate regulations for that I will, here it is. I am not reading out because there are not, generally people don't do it. Like you see government approval for import of secondary machinery, then import of capital goods, and then pre-operative and pre-incorporation. This is very important. Like rent before you got incorporated for conditions, verification by statutory auditors, it has to be done within 180 days of your incorporation of a company. Then there is another regulation. Yes, you see, when you have incorporation expenses. Either you come here, pre-incorporation, or you come next slide. In case of wholly owned subsidiary, you can have pre-incorporation priority up to 5% of authorized capital or $5 lakh, whichever is low, which you can allot shares. So there are two options available for pre-operative pre-incorporation expenses. One is 180 days, or second is in case of wholly owned subsidiary. So there are two which people generally miss out, and people struggle how to issue shares against these, which are not necessarily given to the company, but to a third party like advocate consultant. So this is also permissible under this thing. Reporting is fresh issue FCGPR, transfer is TRS, and you have to file annual return, which is called FLA. It is applicable to a company which has ODI or FDI, either of them or both of them, as on the last date of financial year, which is 31st March. Here, irrespective of whose financial year, it has to April to March. So this is filed every year by 31st of July, 15th of July. So this will go into July. If you don't file, this also attracts late filing fee. So people file it on time, right? And this is important to understand which categories FCGPR gets attracted. I have abstracted it from the manual so that it is easier to understand. Preferential allotment, private placement, right issue, bonus issue, merger including cross merger, subscriber to memorandum, conversion of convertible notes, equity instrument to FECI, ESOPs, sweat equity, demerger, amalgamation, rectification, etc. Oh, close. इसमें नहीं आ रहा मेरे फिर नो अरे बुलाना फिर बंद हो गया इसका यार that FCRA. It will take 10 minutes there, so better over. Okay. So FCGPR, I have given you what are the possible eventualities. Other than this, I have not understood anything else. If it is covered here, I think more or less you are through. Similarly, for FCTRS, it is transfer type. Transfer from NR to NRI, all these what I discussed earlier, non-repatriable, repatriable, NRI, non-NRI, everything is covered here. So you read one by one, I think you understand, because these are case-specific, fact-specific. So my deliberation on this is not required or important, because your facts you have to apply here, only when done. Then it is a reason, same thing. Open offer for sale, IPO, private placement, swap, sale through stock exchange by FPIs, NRIs, purchase of stock exchange, participation, merger, demerger, everything covered here, right? So this is all coming under FCTRS. And debt instruments, which is non-debt. This is debt means debt purely. NRI and OCI, because this was a chapter investments. So NRI, OCI under this debt instrument regulation can invest either repatriation, which is this phase, and non-repatriation next phase. What is repatriation? You can do it. Government debt security, treasury bills, without limit. Domestic mutual funds, less than 50% here, 50% more than percent comes as a non-debt. Then bonds of PSUs, infrastructure debt, non-convertible preference shares, and banks, etc. Subscription to national pension scheme. And then you can also have exchange-traded derivative contracts. And non-repatriation is same, basically. And then without limit in the chits also NRI can invest. And mode of payment is same. If you want it to be repatriable, then bring in from abroad or use your funds, NRE or FCNR. If it's non-repatriable, then only NRO, it will get credited, and then you can take it abroad under 1 million scheme, not otherwise, and current income unlimited. So not thank you yet. So now I will cover FCRA, right? And then we'll close, right? FCRA I will cover. The Foreign Contribution Regulation Act, which says any funds coming from abroad by any person or entity, generally these are charitable, either societies, charitable trusts, Section 8 companies. Even it applies to private limited company, public limited company, listed company, or any other entity which receives the funds for the purpose of doing it for a charitable purpose. They have described 4 words, social, something like that. I will read it out to you. So this is more or less what you have in Income Tax Act, right? Income Tax Act defines 4 and then the other utility. But you assume everything is what is income tax is if you want to use anything for charitable it is this law applies, right? So to whom it applies or to whom it will not apply? If I relate it to FEMA, then how it is applicable? Because in the FCRA Act it says anything not defined here, you fall back to definition under FEMA. So NRI not defined here, you fall back under FEMA. नहीं होगा तो उसमें क्या है? Let me open it in any case on my side now. So what it says, a person can receive foreign contribution. It must have a definite cultural, economic, educational, religious and social program, right? So these are the purposes for which if you get any funding, FCRA applies. And FCRA overrides any other act. It is monitored by Ministry of Home Affairs. But anything which is commercial in nature or business in nature, that is not part of this. Like fees charged by education institutions, import of goods and services, which is in the normal course of business operations, which is a current account transaction under FEMA, so that is not covered by FCRA. It is only cultural, economic, education, religious, social program, which gets covered here. Like delegation fee, if you have a program in India, delegates come from abroad and then they attend the program, that is also not covered by this FCRA. But if it is as a part of, you give donation to some institution here, let me put all institutions in one category, trust. I use the word trust, which includes all categories, whether it is a society, section 25 company, kuch bhi ho, I say a trust, charitable trust. If a charitable trust receives any money, right, and then it organizes any program, and the trust is involved in these 5 or 6 categories, then it is applicable. How to use it is different. But if I directly pay for attending some program, it is not FCRA, right? Now, what is not covered? Who is covered? Covered is a foreigner. It's a foreign contribution, means somebody foreign source. Foreign source is any source. Indian passport holders is not foreign source. It means NRI holding Indian passport is not a foreign source. Irrespective kahan hai wo. Anybody else who is not a Indian passport holder is a foreign citizen, even if staying in India, is covered by this regulation. It means if a foreign citizen residing in India, forget about FEMA status, if he gives anybody some money for the program, he has to comply with FCRA regulation, which is generally people don't follow, it's a different matter, but this is what the law provides. NRI can give money from anywhere, whether from foreign, from India account, and you say they would all exempt. Now there is a regulation, FCRA money can come only in one designated bank account, that is SBI Parliament Street, New Delhi. It can't come in any other bank account, only one account. From there it can be distributed. But NRI is not treated as foreign contribution, so the funds received NRI, even if it's a foreign fund, cannot be credited to that account because that is monitored for FCRA. It has to go to some other account of the institution because it is not foreign funds. NRI collects money abroad from different people who are not NRIs, who are OCI holders and foreign national, remits money to India. It means a resident from FCRA point of view, collecting money from others is indulging into FCRA. He is not allowed to collect it and then send it to India, as if it is my money, right? So that is a contravention of law. NRI sends money to his relatives in India, mother, father, brother, whosoever. So long as it is for personal use, no problem. If ultimately purpose is going to these institutions, he's not NRI, he's an OCI, it has to comply with FCRA because it's an indirect use of funds, right? Now the important question is, what about share capital of a Section 8 company when getting incorporated? Is it a foreign contribution or not? Under FCRA, if I take shares of a company, it is FDI, FCGPR. Even if it is Section 8 company, I have to file FCGPR, if it's a fresh issue. Section 8 company can be incorporated with or without share capital. Without share capital, it can be guarantee also. It means no share capital, but I am guaranteeing some amount when in case of dissolution I will pay, right? But there is no immediate inward remittance. So what it says, if it is subscriber is a foreigner and the purpose of this Section 8 company is charitable, then even to get money, they have to get prior approval of FCRA or of the Ministry of Home Affairs before you subscribe the company. People are avoiding it because generally permission is not given like this. So what they do, they incorporate the company with Indian residents, and thereafter they will, if they have to induct, then they induct it in a different category. But FEMA says if the FDI is coming in a company which is in the social sector as a capital, FEMA has no issue on that. FEMA says it is fine with me, no issue. Only if it is a contribution towards those particular objects and activities, that FCRA comes into play, because that is a kind of a current account transaction coming to India for use in India. एक होता है, I have remitted money to India in a capital which is a capital account transaction. Sending money to India to some outfit, whosoever it is, for the purpose of spending it is a current account transaction. Current account transaction is not, current account transaction is covered by FCRA. Capital account is not covered by FCRA. So generally a view is, don't incorporate a company by foreigners whose business is covered by these categories, especially Section 8 company, avoid it. And then, can a foreigner, citizen of foreign country can become a director in the company or become a managing trustee or part of the governing body? Answer is no. No foreign national can become a governing body member or a main trustee or a director in any of the company wherever you receive the funds. Only exemption, there are few exemptions. If you are OCI card holder, you are foreigner, but you are OCI card holder, so you are person of Indian origin, that is the exemption. Another question comes, will the same principle, this is one. And now the other question is, if a foreign company has a subsidiary in India, more than 50% or 100%, is that covered by FCRA? Means if that company gives a donation, it was covered by FCRA earlier. Then in Finance Act 16, effective from September 10, retrospective, government amended FCRA definition to save political parties, because they had taken a lot of funding from those companies where more than 50% is held by foreigners, like Vedanta or, let me not name, you understand, more than 50% is foreign holding. So there is a foreign holding, it's a foreign source. So you can't take money from them because it is without approval. So then everybody got stuck, including, and political parties are banned from accepting any funds. In any case, political parties are banned from any fund. Others can accept with prior permission or with general condition. For 3 years, you take prior permission. After 3 years, if you register, then you can take continuously. So they got stuck in High Court. After that, they changed the law with effective from 2010 that political party, any contribution made by an Indian company registered in India who has received FDI as per FEMA law is not a foreign source. So it means finish. It means any company with foreign investment today is Indian company, not a foreign company. But any foreign company operating in India as a liaison office, branch office is covered. But liaison officer, branch office under FEMA, under the branch office regulations, is not allowed to do these activities. Liaison office is allowed to do only those activities, only post office liaisoning. Branch office is not covered, the activity are not covered, this, so branch is out. Only liaison office left, liaison office still can do, I am doing liaisoning. If it is doing liaisoning for its own activity, then it is permissible. If it is by bringing money, liaison office giving money to a charitable organization for doing charitable purpose, then it is a contribution, FCRA. I got some reference from somebody, the person was doing the same thing. Incorporated liaison office and brought in money in that liaison office and using it for donation. I said this is contravention of the one. If it's using for self, then self for meeting expensive liaison office, so that is fine. So this is another aspect. So understood, right? And foreigners, as I said, cannot be appointed to executive committee, not permitted. Exemptions is for OCI, and foreigner if married to an Indian citizen, living in India for more than 5 years, he has specialized knowledge, is a government funded, government to government, intergovernment, this thing, or ex officio or multilateral body, and not advisable to do it. And they have asked SBI through that FAQs to banks that please don't accept any money from NRI, even if it is in rupee or foreign, into special account. Let it go to another account because it is not permissible. And other issue is I have discussed about liaison office. दूसरा issue होता है, you see, if a relative gets a gift of 10 lakh above from abroad, he has to file form with Ministry of Home Affairs. So there I have taken opinion and I did a lot of research on this. It says if the gift is for personal use, then no filing is required. If it is used for some purpose, then FCRA applies. If it is received by some prohibited person like politicians, etc., they have to file, not everybody. Suppose I receive a gift from my family member abroad, I have not to file that form. Nobody is filing and nobody is concerned about it. Last is OI regulation, which ODI will cover. If there is a gift from a resident to another resident of foreign security, then it has to as per FCRA regulation. Otherwise, I don't think there is anything else. And recently, this amendment bill has been introduced for some major amendment. The major amendment in that is, in case your registration is under suspension or cessation or whatever, then all the properties or assets of that outfit will vest with the government through a prescribed authority. It means you can't even use whatever you have, so that you are barred from use. You are non-FCRA if you are under suspension, under cessation, or under investigation. It means everything comes to government. So it means you cannot do whatever funds you have. They're all seized for the time being. So, sir, thank you very much. I have finished on this. So, any question you want to take now, or maybe at the lunch you can come and discuss with me.
So good afternoon, everyone. On behalf of the ICAI Ahmedabad branch, I feel truly honored to present vote of thanks for our esteemed faculty for this day 5 of this 11-day FEMA series. First and foremost, I would like to, propose. I would like to say the thank you for our esteemed speaker, C. Vijay Gupta sir, for delivering such an insightful session and enriching session. Sir, your expertise and practical perspective provided, immense value to our understanding of FEMA. As we can see in his PPT, that authenticity that he has done cross-referencing of every Companies Act, DPIIT Act, or any other references. So he had tried everything to make us understanding the FEMA and to give a taste of FEMA, that what FEMA look like. So again, sir, thank you so much, sir, for this wonderful session. Further, I would like to say thank you to our branch chairman, C. Rinkesh, and the whole committee for conducting such sessions for our members. And further, I would like to say thank you for our coordinators, organizing team, and whole members or people who are working behind this and working tirelessly for ensuring that this event, make a great success. And lastly, I would like to say thank you to all the participants who for their involvement and active participation for this FEMA series. And with this, we conclude the day 5 of 11-day FEMA series. Thank you so much. Thank you again. And we look forward for your continued participation. Thank you.